Mia, are you here?
Yes.
Gabby, are you here?
Here.
Margaret? Oksana?
Here.
Power?
Here.
Dan?
Here.
Lizette?
Here.
Hannah?
Here.
Matt, are you here with us?
Here.
Yeah, thank you. Okay, so we're going to first. Let me record this. Give me a second. Oh, here we go. Record. Record cloud. Okay, so that's everybody. Today we're going to do practice quiz. The next practice quiz 3. Which let me share with you guys. You guys get a chance to work on that? Hopefully, yes. Right? I would guess so. If you didn't get a chance to work on it, I don't know what to tell you. Let's do it. Again, as I mentioned before, the practice and preparation for the class comes from your end. Doing these practice quizzes are not mandatory, but it could only help you. It can only benefit you if you do them beforehand. Same thing goes with reading the chapter. Same thing goes for attempting the problems. That's only going to benefit you. And one of the things I mentioned in today's class, as far as the 5 Ps, I'm sure some of you probably heard about the 5 Ps before. Proper preparation prevents poor performance. So take a look at that. All right, let's take a look at the quiz. Again, the first one's a vacation home. Personal days are 20. Is 20 more than 14?
Yep.
Yes. Is 20 more than 10% of rental days?
Yes.
So what do we have here?
What's it called? A rental personal uh, house. A vacation
No.
home. Yes.
Vacation from
But I'm sorry. The chapter was talking about personal rental house. Like the slash was like distinction.
But when we talk about it in the class, and in the book even mentions it, what is the classification? It's not a personal rental or rental personal. It's either rental under Section 469 or it's vacation under Section what? 288, right? So it can't be both. Remember that it cannot be both. So you need to make that distinction that it's a vacation home, which rules apply. Speaking of which, so how would it work? So rule number one, since we're on the topic, if it was a rental property, then you're allowed to deduct the losses. Well, to a certain extent, we'll talk about that in more detail later when we cover investors' losses. But if it's a vacation home, again, and this is where you need to understand the difference. If it's a vacation home, are we allowed to deduct the loss? Are we on a vacation home? I'm asking the class. Are we allowed to?
no
No. Expenses are limited to the income from the vacation home. And what are the 3 categories of the expenses? What are those 3 categories?
Interest
interest
and
and
taxes.
tax.
Yep.
Yeah, interest taxes is the first category. Second category is other expenses, then depreciation. When we talked about allocating expenses and using the tax cord method, that's the method that I prefer to use. Um, or we're not going to use the IRS method. So as far as we're talking about this, and then I'll show you the answer. As far as the tax court method, so we got interest and taxes of how much? $2,000, right? And what else do we have? We have other expenses of $1,000. Rental income is 3,500. All right, and again, so personal days we have it at 20, right? Rental days we have it at 30, right? Okay, so I'm gonna pull up the spreadsheet that I've been using. We can figure this out. And other expenses we have 1,000, right? And then we have depreciation 5,000, right? Okay, so I'm going to show you the screen of what I'm referring to so you guys can see. All right. Okay, so that's the information. A personal days is greater than 3 and greater than 14. Now, I use this spreadsheet from another problem. So I got to change the numbers. So this equation is going to be not 70 over 35. What's the equation here? Somebody help me here.
30.
30. So rental days on top, right? So 30 days over 365. So over here we got 2,000, right? 2,000 times 40 over 365, right? So that leaves you with allocating 219 to the vacation home, a deduction for AGI, right?
Wait, 40, not 30? Should be 30, right?
Oh yeah, I knew that. Just making sure you're paying attention. Okay. Yeah, that's better, right? Is that better? Yeah, that's better. 164, does that look better now? Yeah, that looks better. So 164 allocated to the vacation home, right? So that leaves 1836 to personal. So 164 is a deduction for AGI and Schedule E, right? Part of the computation. You don't do it separately. It's all part of Schedule E. What about the 1836? I keep forgetting. Itemized deductions are deductions for AGI or deductions from AGI. I keep forgetting how this goes. Somebody help me with this one. Anybody?
From.
Deductions from AGI. Again, deductions from AGI. So you either take the standard deduction or the itemized deduction, right? All right, so that's a deduction from AGI included with other deductions. So over here, this equation is going to be 30 over, not 30 over 100. What is it going to be? 30 over what? 50, right? Yeah, 30 over 50. And then the bottom one's going to be 30 over 50, right? So the first one's going to be 1,000 times 30 divided by 50, right? What does that equal? 600,
600.
right? So 600 is allocated to the vacation home as a deduction for AGI. 400 is allocated to personal as a deduction from AGI, right? Right?
Mhm.
No.
Oh, sorry.
No, not deductible. Yeah, $400 is not deductible. What was the depreciation again? I think I got that one wrong. Either way, it's limited. I think no, it is 5,000. Never mind. It is 5,000. I thought it was a lesser amount. So $5,000. That's in total, but we're allocating 30 over 50, so 3/5 of it. Um, but it's going to be limited, right? But I just need to know it's going to be, so we're going to carry it forward. So this times 3 over 5, basically, right? So $3,000, right? So if $3,000 is allocated to the vacation home, how much is personal?
2.
Yeah, $2,000, right? However, we're not deducting the full $3,000 because rule number one, you can't deduct a loss, right? So what is the limit? 2736, right? So over here is going to be, how am I going to explain this? Well, there's a lot of things to explain here, right? So first, um, only the personal portion for category one, and that's interest and taxes, are deductible as itemized deductions. But that doesn't mean that, I mean, you're still deducting the business side on the vacation side, but in terms of the personal expenses, you cannot deduct other expenses on the personal. You can't deduct depreciation on the personal use portion. So that's what I'm referring to. So deductions for vacation home are deductions for AGI. I don't know if you want to know this, but it's reported on schedules E However, these are limited to gross income. What will be the depreciation that carries over? Depreciation or excess depreciation? Well, depreciation of how much? So we're deducting $3,000, but we're only using 2736. What's left over? Somebody with the calculator. I don't have my calculator. 206, $264. Did you just give me cents? Why did you- No, don't do that. Stop doing that. No, don't give me cents. That's not good practice. When you do your tax return, do you write cents? Do you? Why? Stop doing that. Seriously, stop doing that. I'm gonna start taking off points if you do that on my exams. Just stop doing that. Seriously. The instructions tell you clearly you round to the nearest dollar. What is the point? Even when they issue the check, they're not gonna. It's unlikely they'll give you a check with the cents. Or the state might, but the IRS is unlikely they'll give you a check with the cent. They might. They usually tend to round to the nearest dollar, and it actually makes it easier for them. And the thing about, even if you look up the IRS transcripts, the way the transcripts work, it's actually rounded down and not rounded up, which is actually weird. The way the IRS, the way they round, it's actually pretty unique. Nonetheless, use whole dollars. You don't, to the nearest cent. It's, use whole dollars. It's $264 would be fine, or $264 and how many cents? That's, you know, I'm not gonna. Yeah. So what would it? How much would you deduct on as an itemized deduction? Even? Very. Well, you're finally paying attention. Thank you. But what would you have really put the actual cent as an itemized deduction? It, yes, it's really. It's you're gonna. It's not. I don't know. Nobody does that really. It's round to the nearest dollar. Only time, even in accounting, it's I don't think you really grasp the concept of materiality if you're really spending a lot of time to get to the nearest cent. I get it. As an accountant, we're anal retentive. We want to balance, but there's something called materiality. You're not going to spend dollars chasing pennies, and that's what I'm trying to, and I hope you understand that materiality. If it's $1 or $2 off, it's within the materiality framework. It's accounting principle. It's nothing else. Nothing. It's not being dishonest. You're rounded to the nearest dollar. I guess maybe let me ask you a better question. Since this is not really an accounting class, but this sort of pertains to what we're going to cover in a few minutes. A fixed asset is a non-current operating asset, meaning it has a useful life over a year. Um, I don't know if you can see this. But for starters, a laptop that has a useful life over a year, and I'm going to use it in operations. A laptop is a fixed asset, right? Furniture that has a useful life over a year, I'm going to use it in operations. That's a fixed asset, right? Everybody agree with me so far on that?
Mhm.
How about this stapler? Can you guys see this stapler? Is this a fixed asset by that definition?
Kind of.
Does No, no, no. Well, listen to the definition. Does this have a useful life greater than a year? I've been using this one for years. Matthew, does this have a useful life greater
Yes.
than a year? Is it used in operations?
Yes.
But why did you quickly go to no?
Because it would be considered an office expense. Because, like you
No,
said,
but that's not the
material.
that's not the concept that you're referring to. But why would you automatically? You're actually contradicting a basic accounting concept. If you know that it has a useful life greater than a year, why not capitalize it and depreciate it?
I'm sorry, you cut out there.
Why would you not capitalize it and depreciate it if it has a useful life greater than a year?
It would be burdensome. It would
That's
be
not an accounting principle. Burdensome is not an accounting principle, but you're onto something. I'll give you a hint. I just said this term a few seconds ago. It seems like you do understand it. You put it in office expense or wherever you're going to put it, but why? Not because it's burdensome, but you're close. Because it's immaterial.
oh, okay. Well, I said
Most
because of
companies-
materiality. I thought okay.
because of materiality, it's immaterial. Uh, Companies do that. They have a threshold. Some companies use a low threshold, like $500. So if they buy anything that's $500 or more, it gets treated as a fixed asset. That's disclosed in the financial statement. That's their threshold. Bigger companies may have a higher threshold, $1,000 or more. Anything under that, even though it meets the definition of a fixed asset, gets expensed because it's immaterial. That's because it's burdensome. That concept does not exist in accounting. Materiality does exist in accounting. It actually even exists in the legal world. Materiality is not I want you to really understand that, concept because it pertains to, tax class and also pertains to accounting class. Um, Speaking of which, even with depreciation, there's certain aspects where you can just expense it, again, under the same principle. If it's immaterial, under the same principle, you treat it as an expense, even though we know this stapler is a fixed asset. This stapler is a fixed asset. It's a non-current operating asset. Why not depreciate it? Well, of course, we're not going to depreciate it. It's much, it's immaterial. We're going to, we're going to expense it. You're still going to recover the cost. So enough about that. So any questions on this one, the tax court method? Make sure you understand what's deductible, what's not deductible, how do we allocate expenses in case I do ask you this question again. Chances are I'll probably will. Next question. No questions? No questions here? All right, I'm going to switch over to the questions again. This one I don't have the answer to, so I'm going to need your help. And I can't find my calculator. I had it right here. All right, so I'm going to need your help with this one. I know there's several steps we have to do. So I'm using $12,000, so standard deduction for 2018. Step number one. Who wants to give me the step number one? Mia. Step number one for net operating losses.
The business revenue, right?
Well, compute net loss. So your
Net loss.
business. I'm going to abbreviate business loss. So you have. So Mia, you said something about.
Yeah, so it's
revenue?
the 175,000 minus the 250,000.
Okay, again, I misplaced my calculator, so I need your help. What would this equal?
75.
75,000, right?
Mm-hmm.
Okay, everybody okay with that? Step number one, compute net loss. Dan, what's the next step? Dan, are you here? Dan Post. No, you're here. I can see you. All right, we'll come back to Dan. I don't think he can. I want to call on everybody today. Hannah, you're next on the list. Hannah, what's
Yep.
the next?
The next step would be to compute AGI.
Okay, so we need salary, right? Salary,
Yep.
that's income. Salary, that's 45.
Mm-hmm. And then
Uh,
the corporate dividends.
Dividends. How much is that? 21.
2150.
Okay. And that's it, right?
That's for gross income. But then you'd have to subtract the 75,000 for AGI.
Right, which I already have. That's why I grouped it in there. But you're right. That's
I wasn't looking at the screen. I was looking at my notes. Yeah.
okay. So minus 75,000. So I'm including everything. The net loss. Actually, let's just do it that way. The way you just explained it. So step one, and then step two. I'm just gonna put it in net business loss. Again, in case you know, that goes on schedule C. And that is 75,000. That's a deduction for AGI, right? So what is your adjusted gross income, Hannah?
27,850.
27,850.
Yeah, negative. Yeah.
Okay, but that's not the NOL, right?
No, that's just AGI.
Okay, so who's next? Dan, are you back? Dan?
I am. Sorry.
Okay,
Did I
what's
get
next?
called on before?
I called on you before.
Sorry. I had to step away from my computer for a minute.
Okay. What's the next step? After adjusted gross income, we deduct either or. What do we deduct? Either or. I'm giving you a hint. It's either or, but not both. You can ask the audience.
Itemized deduction.
Yeah, or standard. Sorry.
Yeah, it happens to us. Remember, itemized deduction is a deduction from AGI, 12,150. Now, one thing we started talking about is deduction on qualified business income. Do we deduct it here? Why or why not? What do you guys think? Anybody can jump in if you want to comment on that. How come deduction on qualified business income, how come I'm not including it here? Because it's a loss, right? In order to have a deduction on qualified business income, just if you understand the rules, that 20%, the lesser of qualified business income or modified taxable income. Either way it goes, if we're taking negative, 20% of this number or 20% of 27,850 minus 12,150, it's negative. You don't take a deduction. So no deduction on qualified business income. So what's the taxable income here? Anybody? Somebody?
40,000.
40,000 even, yes. That's not my NOL, right? So now I do my NOL computation. I know I start out with my taxable income, all right? Taxable income from the number I just came up with, 40,000. Gabby, what's next? You're gonna add something. What do we add? I'll start it out. It's N, B, D minus N, B, I. What is that? I'll give you a hint. I'm typing it. What is it? I'm using a lot of abbreviations today. But what is the NBD minus NBI? Somebody want to help me with that? I actually gave you those numbers.
Non-business deduction. What was it? Non-business deduction minus non-business income.
Yes, non-business deduction and excess of non-business income. So just keep that in mind. There's going to be a couple of problems that we're going to go over where non-business income is more. We don't do anything there. It's a zero adjustment. But in this case, when non-business deduction exceeds non-business income, you add back the difference. And we talked about this last session in terms of what non-business deductions are and non-business income. So you really have to go and review your notes on and understanding the different types of income. Active income, right? What goes in that group of active income, that's business income. And then the other categories, category 2, portfolio income, which we've talked about in this already, and then the category 3, which is passive income, which is what we're going to talk about today. That's non-business income. Those two categories are non-business income. So even
if it's a salary, that's considered business income.
Yes.
Even though it's not the business receipts.
Yes.
Because it's active.
Yes.
Okay.
Exactly because it's active. Oh, by the way, did I tell you I wrote an article about this? It's on my one of the notes. Take a look at that article. It's somewhat dated. Now that I mentioned it, but I do talk about net operating losses. I talk about the rules of materiality. But that was under the old rule, under the Tax Cuts, before the Tax Cuts and Jobs Act. So that has changed. So yeah, the $30,000 loss, right? Everybody okay with the $30,000 net operating loss? Yes? Now, let's say I were to ask you in relation to the loss, NOLs incurred in 2018, 2019, and 2020 can be carried back up, well, 5 years, right? 5 years, and carried forward for how many years? Well, it's actually indefinitely. I guess forever, right? Forever, or until exhausted, until used. What else can you tell me about these NOL rules? NOL can offset up to 100% of taxable income in the carry over year, right? Again, I know the book doesn't talk about this, but I talked about it, right? So even if the book doesn't mention it and I talk about it, is that going to be on the exam? What do you guys think? Yes, it's going to be on the exam. So if I ask you a question, what option does this taxpayer have in terms of net operating losses? What's your explanation going to be? I want you to be current, and because the CARES Act is something current, that's what you have to. That's what you have to tell me. Well, you don't even have to mention the CARES Act, but as long as you understand that losses that NOLs that were incurred in 2018, 2019, and 2020 can be carried back up to 5 years and carry forward indefinitely. And again, and the 80% limitation on taxable income does not apply. As long as you understand that. And then, of course, I could mention, however, tax NOLs, I guess after, will follow the Tax Cuts and Jobs Act rules. No carry back, only carry forward, right? Limited to 80% of taxable income. And I do want you to understand the difference between the two, because this is practical. That's something that you need to apply. If you see it, again, even though the book doesn't mention it, this is new law. You need to be current on it. Any question on the NOL?
Yeah, I have a question. So for the first sentence where you said it can be carried back 5 years and carried forward, is the first year still 80% and the second ones are 100, or is every year?
It's any NOLs that happen in those years. So any NOLs that once you do this computation, and it still results in an NOL, if it's in 2018, 19, or 20, it's carried back 5 years and carry forward whenever you can use it, and it's 100% of taxable income.
Okay, and then the other years, sorry, it's only 1 year. The other years, it's 80%.
Yeah, then it's 80%. Then it follows the Tax Cuts and Jobs Act rules. And remember the other.
Okay.
And then also, what else did we talk about? Excess business losses do not exist per CARES Act. I should say limitation. Well, I don't want to talk about that anymore. I'm a bit upset about that. It did create somewhat of a loop, or reopen the loophole, because that law was always open. There are some limitations. The limitations we're going to talk about today are there are some limitations in curbing tax shelters. We'll talk about that today. But this was a big one. They added that as part of the Tax Cuts and Jobs Act, and then they took it away as part of the CARES Act. The book does mention the excess business losses. They do talk about it. $500,000 up to that amount, or is actually indexed. It's a little bit more, and $250,000 for a single. Again, those numbers are indexed. Those numbers don't exist anymore. The reason why I talk about it here, because it's NOLs did attribute to those excess business losses, but they don't exist anymore. Oh, this one's fun. Three. So Of the following assets, let's have fun with this one. Warehouse. Warehouse is mid-month, right? I think it's mid-month convention. Convention with a useful life of how many years? How many years? Anybody know this? Dan, do you know the answer to this? 39 years, right?
Yep.
All right, so let's do the math real quick. So in October, even though I didn't ask you to do this, well, actually, let's do the conventions real quick, and then I'll do the depreciation so you guys can see how it works. All right, so what about the other two? Computer equipment. Computer equipment that was placed in service, again, 75,000. And what quarter was that? No, July. That was not the second quarter, right? That was the third quarter, right? So I'm gonna put 3Q, right? And then what about the other one? And that's the other one would be furniture, right? And that was 95,000. If you add those two numbers up, what do we come up with? If you add those two numbers up,
170.
170. 95, help me with this. 95 divided by 170, what does that equal? Anybody? 95 divided by 170. Anybody with the calculator? Somebody. 56%. So what does that mean? If 56% is in the last quarter, I know there was a rule. If over X of personal T assets are placed in the last quarter, what convention are we going to use? Mid-quarter, right? Again, 40%, right, is the rule. Make sure you understand that because that's something that I will ask you questions on. That's the mid-quarter convention. By the way, this is computers are 5-year, are 7-year. I'm not going to expect you to memorize it, but we are going to use the tables right now. All right, any questions so far on the conventions? Because now we're going to do some of the computations. Okay, warehouse is 39 years. Again, help me with the math. It's going to be 125,000, right? Divided by 39 years, right? I'm just going to show you how it would look for year one. So, and then year two as well. So year one, this is going to be the depreciation. 125,000 divided by 39. But we're not going to take a full year of depreciation. We're going to take, well, let's see. It's mid-month convention, so we're assuming that we're going to put it in the middle of October, right? And then we have November and December, so 2.5 months, right? Divided by 12. What does that equal for the first year? Again, 2 months because November and December, we're counting that at full months. In October, it doesn't matter if they place it in service in the beginning of the month, middle of the month. It's mid-month convention. It's assumed that it's placed in service in the middle of the month. So what does that equal? Matt, did you come up with an answer here? Again, 125,000 divided by 39. That's for the full year, but we're only taking 2.5 twelfths of it for the first year. What do we come up with? Matt, are you still with us?
Fine.
Round to the nearest dollar, by the way.
I got 668.
668? Rounding to the nearest dollar. Okay, that works. Year two. How would I do year two? Year two is actually pretty basic. 125,000 divided by 39, right? Time, I don't have to do the rest part, but I want you to understand what we're doing here. Times 12 over 12. Why am I doing 12 over 12 for the second year? I don't even have to do that, but why am I doing 12
It's a full year, so it's 12 months.
It's a full year of depreciation. And then let's say they sold it in February of the third year. then you're going to multiply by 1.5, one for the year before and one for the year that they're selling it. All right, so what is the depreciation here? Anybody?
3205.
3,205. Everybody okay with that? Okay, for the next part of this show, I'm going to show you the tables that we're going to use. So I trust that you guys been reading during the 4th of July. In addition to doing the homework assignments, can you believe we only have a couple more weeks left? Are you guys excited about the final? Yeah, you should be excited about the final.
Are you teaching the Thursday night audit class in the fall?
I think so. I don't know what my schedule looks like. I got intermediate accounting one. If I know that I'm gonna say 215 corporate entity classes should be offered in the fall. And auditing.
And you said you're doing intermediate accounting online or over Zoom?
Well, I don't. It's not up to me. It's up to the school. It's really yeah. It's not up to me.
I just saw there was like one option in person, I think, and one, I think, over Zoom. But I'll look. I was just wondering if it was you.
Yeah, that's news to me. My thoughts was it's just gonna be either either on class or again at the decision.
I could be wrong. I read it quickly, but I'll look again. It could have been that too.
That's actually, so yeah, online classes are always going to be online classes. This is not an online class, just so you know. This is not an online class. This is more of like a hybrid. You know, online class that don't have a lectures, you have discussions, and a lot of it is yeah, you don't meet. We don't meet for online classes. You don't meet once a week. We just do the discussions online. You do your quizzes online, and it's pretty much up to you. More independent study, I guess. But this is we're trying to simulate an actual class on campus. The best that we can do right now is hybrid format. I don't know what's going on with this today. Let me try a different book. Let me try this one. So so just be on the lookout for that. I don't want to speculate as to how it's going to be offered. It's just tough to say. I will tell you this: what the Illinois CPA Society has done. The Illinois CPA Society has other seminars, continuing education seminars, are virtual this year. They made that decision. The conferences that we've had, the summit that we have in August, that's going to be virtual, including the cannabis conference, which I'll be speaking, talking about taxes, not cannabis. And that's going to be virtual now, so it's going to be different now. Why am I saying that? Because again, it surprised me that they would make that decision, that much in advance. But I guess other organizations are doing the same. Again, just something to be aware of. If some institutions, some organizations are already implementing a policy just to do everything virtual, this year, I would not be surprised if the college does the same. But again, right now I can't say for certain as to what their thoughts about it are. I guess just be ready either way. The only thing that I would say, if we're gonna be on campus, just again take the proper precautions. If you're feeling sick, don't come on campus. What else? And then wear a mask. I'm sure that's going to be a requirement. If you're going to be on campus, you're going to wear a mask. That's going to be a requirement. Pretty sure all across the board. There's a problem that I want to go over, and this is similar to what the book has in terms of using Section 179 and getting out of mid-quarter convention. And that's probably one of my problems that I'm going to go over. I'm looking for the mid-quarter tables and the half-year tables. So you can see how it works. And I'm going to change the numbers in a bit. Okay, special rules. And it talks about the conventions here, but anybody remember where the tables are in this chapter? Anybody? Matt, do you know where the tables are? Here they, well, I know, well, here's the concept. But I want a table. There's a partial table in one of these. And I could tell you the percentages, but you're not gonna believe me what the percentages are. Again, here's just a different classification. And here's the different conventions. It talks about the conventions. Yeah, I can't find it. No, this isn't it. It's in here. Maybe it's at the end.
Can you check
Find it?
page 833?
833, hold on. You know what? Screw this. I'm gonna just go to the IRS website. This is taking too long. Wait, here it is. What page?
She said 833.
833.
830. Yeah, I got a different page. It doesn't align with what you have. Oh, 833 over here. So I have 333. So it should be over here. You know what? Screw this. I'm gonna, excuse my French. I'm gonna go to, wait. I'm gonna go to the IRS website. I may need to restart my laptop in a bit. All right, so just so you can get an idea, for a 5-year asset, again, so for a 5-year asset under the half-year convention, it's 20%. So think about that for a sec. If it's 20% for the first year, just how much would it be using the mid-quarter convention? So 4562. 4562 is a depreciation form. I'm gonna look up at their instructions, or right here. And this is slow too. Okay, instructions. Okay, where it is. There we go. It doesn't have the tables here. Oh, here they are. Here they are. You guys see the tables? So this is half-year convention. What is this for? No, this is not the table. What is a partial table? They're not doing the full table. Let me go back to the book. Okay, what page did you say was on? 33? What was that page number?
Yes, 833 going forward.
830, so it should be right around here. I must have missed it. Give me a second.
It's under tax planning. It's like a couple pages after tax planning.
Okay. Oh, thank you. Thank you. That helps. So, and that table, you should see the different quarters depending on the types of assets. This is too slow. Tax planning. That tax planning is towards the end. Yeah, that sounds familiar. It's just taking me a while to get here. Okay, there we go. All right, so let's cost recovery. Come on, you're kidding me. Oh, here are the tables. So here are all the tables that we're gonna do. So thank you for that. All right, so maybe I should just leave it here for right now, not even change it for today's class. So here, this is a half-year table. 5-year asset, again, remember I said that was 20%. I'll tell you how we came up with that 20% in a little bit. 7 years is going to be 14.29, but that's half-year convention. We're not using half-year convention. We're going to use mid-quarter convention for these two assets. So now we're going to use these tables, the tables on the bottom, right? So we said a computer was 5-year asset. You guys see that? 5-year assets. So this is the way it's broken down. Again, it works slightly different the way it's set up. It is kind of funny the way it's set up. It's, if you think about it, all this should equal 100%, right? 35, 25, 15, 5 should equal 100%. But that's not the point. For the first asset, the computer I told you was in the third quarter, right? I think I said that, right? What is the percentage for the first year for a 5-year asset in the third quarter? 15%, right? You guys see that? You guys see the 15%? Yes?
Yes.
Okay.
Yep.
All right, so the 7-year asset. So now we have, again, we got to use mid-quarter for all of them. We cannot use this table because if we bought it more than 40% in the last quarter, placed in a service in the last quarter, more than 40%, this table is not allowed. We got to use the mid-quarter for all of them, except for real estate. Real estate has a different set of rules. The furniture, on the other hand, it was 4-year. I mean, the fourth quarter, right? So that's 3.57. You guys see where I got that number from, right? First year, 3.57. Now let's go back to, again, I didn't ask you this particular portion, but I want you to, understand this. So a computer is going to be 75,000. So 75,000. Again, I'm going to need your help with this times 15%. What does that equal? Somebody with a calculator. Anybody? Somebody? You guys don't have calculators? You guys are accountants. My calculator is here somewhere. 11,000. Thank you. I hate when it does that. 11,250. Thanks for not using cents. I'm going to pick on you.
Yep.
From this point forward about that. I kid, but it's for fun. Don't take it personal. 95,000. So what's the percentage here? This is times 3.5%, right? All right, what does that equal? Again, rounding to the nearest dollars. Again, it tells you even though the forms are not primary authority, but you still got to round. It's good practice, I guess. Best practice. What does this equal? 95,000 times 3.57%.
You got 3,325.
Okay, yeah, that sounds about right. So that's it for the depreciation. Is there a way of getting out of this? Can we depreciate?
Something a little lower. I got
Like very possible.
or a little higher rather. I got 3,391. Is it? You said we round down on fives for the IRS.
What, 3,300? No, I never said to round. I say round. I never said to round down.
Okay,
I said
you said
the
they did. They
IRS
said they
transcripts.
did. Okay.
I said the IRS transcripts
Okay.
round down.
Okay.
The IRS tends to round down, but I've never said to round down. Always follow the basic rules.
Okay.
Say that the IRS,
Then 92.
yeah, so 92. Now, well, I guess you were close. That would be the correct answer if you do in terms of rounding, but the other answer would not be wrong because it's within the not you're not going to get audited if you put that amount of depreciation. Since we're on this
Yeah, I did
topic,
3.5, so that's why I was wrong.
oh, okay. Oh, so I see what you did. No, with these percentages, use the percentages that the table has. So that's a good question. Use
Oh
it,
yeah, no, I just typed it in wrong. Yeah.
yeah, use the percentages, and then that would give you a slightly different answer. I'm actually glad that we're on this topic in terms of rounding, and yeah, don't spend too much time on it. Those of you who are thinking of taking intermediate accounting, like in both classes 1 and especially 2, we talk about the time value of money, discounting bonds payable for the borrower, and bonds as an investment for the investor. So you got to get it into today's dollars. That's an accounting concept, and that is going to be different depending on which table you use. If you use a table that has 3 decimal, I mean, I'm talking about the present value tables. Some present value tables have, for the present value factors, they have 3 decimal places. Some of them have 4. So yeah, your answer is going to be different depending on which table you use. Use my tables, the ones provided in that class, which it's going to be close enough. It's just rounding due to the tables. But not with this. This one is pretty straightforward. Any question on depreciation? We'll talk about that in more detail in a few minutes. There's more to talk about with that, and I want to get into the other deductions as well.
What would a year 2 look like for those 2 items?
I don't know. I think I really don't know. Hold on, I do know. I'm kidding. Then you do the same thing for year 2. So yeah, that's a good question. Year 1. I'm going to show you how the number, the percentages. All you do is just follow the next table, down. I mean the same table, but the next year. So let's see. Going. All right. So what would that percentage be for the second year?
34.
I mean for the 5-year asset?
Yeah, I was looking
Yeah, 34%, right? 34%, right? And what about the furniture? The 25,
27.55.
yeah, 25. Yeah, this one. Oh no, wait. Yeah, you're right.
No, I did the
27.55.
27.
Yeah, because that was in the 4th quarter. So yeah, I won the 4th quarter. So yeah, you just follow it, straight down. So that's how you would do it for that. Since we're on this page, let's say mid-quarter didn't apply. Let's say they placed everything in the first 3 quarters, and it's going to be 20% for the 5-year assets for the first year, and then again for that computer, 32% for the second year, and so forth. For the furniture, it's going to be 14.29 for the first year, and 24.49 for the second year, and so forth. That's the way it would work. I'm not talking about bonus depreciation yet because I'm just applying the basic tables. And I'll tell you how we came up to these numbers in a few minutes because it's actually pretty interesting. Any other questions on either of these tables? Again, we'll walk through more problems with these tables in a few minutes. No questions? Okay. Let's go back to the quiz. The quiz, 3 categories for primary sources of tax law. Why do I keep asking you this question? Because I think it's important. What's the first category? Gabby, are you here with us? Gabby.
Hello?
Yes, you're here?
Yes, I'm here.
All right, give me an example for statutory.
Yes, the 16 amendment.
Okay, when was that passed?
Excuse me?
When did they pass the 16th Amendment?
1986. I don't remember. I'm sorry.
I'll give you a bonus question, a bonus point. Anybody know this one? March 15. Wait. You guys don't know?
1986. No.
No.
1930.
Yeah, you don't have to know that. 16th Amendment is good. Internal Revenue Code. I think I'm just gonna leave it there for that one.
And treaties.
Yeah, okay, treaties, good. Next category, administrative. I'm just gonna abbreviate this one, admin. Who's here? Hannah, wait, no, I think you went already. Power, you here? You were here. He's gone. Hannah, are you still here?
Yeah, I'm here.
All right, give me administrative.
I could do treasury regulations or revenue rulings.
Okay. Rev, proc.
Or like private letter rulings, determination letters.
Very good. You named them all. And then judicial. Case law. See case law. I'm not going to ask for that. Again, understand the difference. Which courts require payments of taxes before filing a petition? I think everybody should get this one. But let me pick on Oksana. You here? Oksana? Oh, we'll come back to you.
Yeah, I'm here.
Okay, there you are.
So
There's two courts that require payment first.
it's U.S. Court of Federal Claims.
I want to abbreviate a federal claim.
U.S. Court of Federal Claims.
Okay.
Tax court.
No, not the tax court.
Tax court.
Yeah, not the tax court. Again, U.S. tax court does not require payment, but requires petitioning within 90 days of deficiency notice. I think everybody mostly got this one. I noticed some of you went into detail about even though I didn't even talk about this much, the small claims division of the U.S. tax court. Just keep in mind that is not an option, that it's not at the taxpayer's discretion. The taxpayers don't file to go to the small claims court. That's at the discretion of the government. If the government wants to settle outside of the court, then that's the way it works. If the taxpayer files a petition to U.S. tax court, they're ready to go to U.S. tax court, not small claims division. They may forward small claims division, refer it for petitioning, but it's ultimately at the decision of the government to settle, so to speak. What I wanted you to understand is just after the small claims division. So U.S. tax court requires that you petition within 90 days of the statutory notice of deficiency, whereas U.S. Court of Federal Claims and U.S. District Court requires payment, but not within that not limited to that 90-day window. And then understanding the whole judicial system, including the Supreme Court. All right. Number 6, 7, and 8. This is a good one. Step 1. Well, I'll figure it out. It's how do we figure out self-employment tax? So we got net income. Step 1, figuring out the net income, right? Net income is 40,000, right? Right? Multiply it by times 92.35%, right? Right?
Yes.
We're waiting for somebody to say that. So you're on the spot, Matt. Was that you, Matt? What is
that was Dan. It was 36,940.
36,940. Oh, that was Dan? Wait.
Yes.
Well, I start acting weird in my office. So that's the SE base, right? That's just a number we use. Next step is multiply it by times 15.3%, right?
Mm-hmm.
And that equals your FICA tax. So what does that equal?
I had 5652.
5, 6, 2. All right, so that's the SE tax, right? SE tax. And then times 50% for the AGI deduction, right?
Mm-hmm.
For the how much would that be for the AGI deduction?
2826.
Yeah, 2,826.
26. Yeah.
That sounds about right. Okay. So we have AGI deduction. Any questions with that one? Okay, we got to do it step by step. This is the reason why I gave you the, I sort of put it in these steps. Maximum amount of the SEP contribution, I know it was something like net income, which is 40,000 times 20%, right? What does that equal? 8,000, right? So even though they made a contribution of 10,000, he could only deduct 8,000 of it. $2,000 can be left there, or shouldn't, but that's the basis, or he can take it out. All right, do we have enough information to figure out the AGI and taxable income? Yes. Well, we also need to do the qualified, the deduction on qualified business income deduction. Again, I'm gonna need your help with this, doing the math. So let's, again, net income. Net income is 40,000, right? Minus deductions for AGI. We have a couple deductions for AGI. 1/2 of SE tax. How much was that? Again, negative 2,826, right? And SEP contribution, right? I'm gonna abbreviate contribution. The most they can deduct is 8,000, right? Even though they made a contribution of more. By the way, this would equal your qualified business income. But in this case, it's AGI, which is going to be the same number. So 40,000 minus 2,826 minus 8,000, what does that give me?
29,174.
Very good. 29,174. Then from that number, we subtract either the standard deduction or itemized deduction. Let's take the standard deduction. Standard deduction is 12,000. And then what do we subtract from that we got to figure, which is the next step? QBID, right? Qualified business income deduction. That I don't know what it is. And then taxable income. I'm going to walk you through the whole thing with this one so you can see how it works. So it gets pretty tricky here. So what is the deduction on qualified business income? Let me put this on another page so you guys can. Everybody okay with the first half of it? Everybody okay here? Okay, because we're gonna need these numbers. But over here is the summary. Again, AGI, we gotta figure out taxable income and deduction on qualified business income. So with this one, if QBI deduction is the lesser of qualified business income, which in this case, it's going to be net income minus 1/2 of self-employment tax minus your SEP contribution minus the health insurance, or the premiums for health insurance plans. That's it. It doesn't always equal your adjusted gross income, but in this case, it does equal your adjusted gross income. So I kind of made it simple. So it's 29,174 times 20%, whatever that's going to give me, right? Or modified taxable income, which is 29,174 minus 12,000. What does that give me? Again, I'm taking my adjusted gross income minus my standard deduction. What does that give me?
17,174.
That number is lower than the 29,174, right? So that's my qualified business income deduction. It's going to be based on the second number. keep that in mind. Think of that as a shortcut way. If all they have is self-employment activity and they don't have salaries, then it's going to be 20% of the modified taxable income. If they have salary and other sources of income, then you got to walk through this example. The QBI would be maybe less. But in this case, modified taxable income is less. Once 17,074 is 20%, what does that equal as a whole dollar? To the nearest dollar. Somebody.
3,435.
Very good. So that's my qualified business income deduction. 3,435, right? So what is the taxable income? Uh, 13,739. Okay. We're gonna do the math on the tax computation, but any questions so far on what we did here? Because the next step
Can
is
can you explain again how the QBI would have been more if there was salary involved? Because I was wondering, like, when would it ever be more than MTI? And I'm
well,
still
think
trying to
about
make
this.
sure I understand that.
Well, think about this for a second. If you add another number, it's always going to be the lesser of the two. Again, QBI in this case is going to be more, so you're going to take the lesser of the two. So it's going to be the modified taxable income. Now think about this for a second. When qualified business income would be less than modified taxable income. Just think about this for a second. If they have net income and they also have salary, your net income is going to be less than your net income and your salary, right? Let me say that again. Your net income, which is your qualified business income, is going to be less than your salary plus your net income, right? That's it. You know, it's as simple as that. Again, net income, which is a qualified business income, that's going to be less than your salary combined, right? And your net and the net income, right? Are you guys understanding the point that I'm trying to make?
Yeah. So the QBI, you have to use salary too, if necessary.
No. QBI, you don't include salary.
Oh, sorry. I mean, MTI, you'd have to include salary.
Yes.
But when you're saying net income, you're just talking about net income from bigger business.
Yeah, the qualified business income, that's your net income. Well, it's not just net income, it's net income minus these two deductions that are related to net income. But I just, kind of just kept it simple. $40,000 is going to be less than $40,000 plus whatever other number is. Just think of it that way. So we walk through the modified taxable income, then naturally a modified taxable income is going to be more than your net income. If you walk through the math, it's just understanding how everything works through these numbers. Again, adjusted gross income is going to be higher if you add salary, right? Right? So that means your taxable income or your modified taxable income is going to be higher if you add salary. But qualified business income itself is just the net income minus these two deductions. So that's why that's going to be less. So again, I do want you to walk through these numbers. So in practice, you should go through the math. But for like if you're taking an exam and you see somebody that has just pretty much all they have is a self-employment activity, then you can just take a shortcut. Again, this is just a tip, by the way. In case you see something like this on the final, which you will, this is going to be the final. You can take a shortcut and not even because if you walk through this and all they have is self-employment income, they probably have dividends. Either way it goes, this is always going to be your modified taxable income is going to be less. So do that as a shortcut way. Take the modified taxable income, which is your adjusted gross income minus either the standard deduction or itemized. That's your modified taxable income. If you're running out of time, if you're not running out of time, of course, walk through the whole math. Just so you can see that the math works. But yeah, I do want you to go out through the whole thing. Any questions with this one before we do the tax computation? I remember the taxable income 17,739, right? So I'm going to put it over here. So TI is 13,739, and I think you guys know what I'm going to ask now, right? Figure out the income tax liability from that, right? I really didn't want to come out of here, but I have to. Sorry. I'm sorry. All right, here we go. So we're taking 13,739, right? Oh, wrong table. Wrong book. Actually, now that we're on this chapter, since this is sort of by accident, by the way, but not totally. Things happen for a reason, right? So the tables that you see right in front of you are what? Tables for estates and trusts, right? For trust specifically. Now take a look at those tables. It doesn't matter the year, but look at the tables. There's only 4 brackets, right? 10%, 24%, 35, and 37. By the way, it's pretty consistent with the way income tax works for individuals. Lower rate and the highest rate are going to be similar, but it's similar. It's going to be the same thing. But the rates in between is going to be, different. But just look at the rates. Keep in mind that for individuals, you're taking the standard deduction as an automatic deduction for everybody, right? The standard deduction alone is actually more than these numbers. The point that I'm trying to make is when somebody it tells you that you should create a trust because it's going to save you money on taxes, show them this table, show them the table for individuals, and ask them to explain to you how is it going to save you money on taxes. Compare the two tables, it is not going to save you money on taxes. Trusts are actually, if you think about it, in terms of effective tax rate, they actually pay more in taxes than individuals, not less. And this is usually, again, don't get me wrong, I do like estates, I do like trusts for the purpose that it does for protecting your assets and conserving your assets and transferring assets to your beneficiaries. I agree with that. But if somebody tries to tell you that you should get a trust to save you money on taxes, that's almost the same thing as saying form an LLC to save you money on taxes. It really doesn't. States don't and trusts don't really save you money on taxes. Just on that act alone, just look at these tables. It's not going to save you money on taxes. But that's not what I wanted to talk about. I want to talk about the income taxes, income tax class. All right, here's the first one. All right. Give me a second. It's just taking a bit of time. All right, tax rate tables. We're using 2018 because this was a 2018 problem with the $12,000. Just all right, bear with me. Next. All right, so single. You guys, what's our tax bracket in this case? 10%, 12%? What do you guys think? Anybody? Yeah, 12%. So it's going to be taxable income of the amount over 9525, right? And that's going to be times 12%. And then we're going to add 952 and 50 cents. Again, right here we do use cents because that's, and the total is going to be the rounding numbers. We're going to use this row, right? The 12% roll. Everybody okay with the 12% roll? All right, let's go back to the problem.
Question about the problem. That 14,000, that's how much taxes they paid or how much they estimated their taxes to be?
Hold on. Hold that question.
Okay.
Yeah, hold that question. That's a very important question. That's a very good question. But we'll get there. So 9,525. By the way, I'll give you a hint. These are federal estimated taxes. I don't know if that helps. All right, so 13,739 minus 9,525. What does that give me? Somebody.
4,214. 4,214.
4,214. Very good. And I'm taking 12% of that, right? What does that equal?
506.
Even? Okay, well, yeah, let's do even. And then we're adding, what are we adding to this? Plus 952.50, right? So what is the income tax here? in this case. So it's going to be 14, what, 14, what? Oh, I need a calculator. It doesn't,
1458 I had.
how about 59?
You can do 59.
That's 59. Everybody agree, 58 would work too, but I guess rounding, I'm using the cents. So 1458, that's the income tax, right? So income tax is 1459. What's the other tax we're paying in addition to income tax in this problem? Is there another tax? I'll give you a hint.
Self-employment tax.
Self-employment tax. SE tax, which is something like 5,000 something or other.
5,652.
So 5,652. All right, total tax.
7,111.
7,111 even? Okay. So on this alone, so federal payments of 14,000 less 7,111 will yield a refund of, what's the refund? What would be the refund? Yeah, they're getting most of it back.
6,889.
Yeah, you're getting most of it back. So federal payments, and I said this before, in terms of your federal payments, estimated payments are estimated payments. They're estimating your taxes you're going to pay, your total tax liability, which includes FICA taxes and any other taxes. What if it was state estimated payments? That would be an itemized deduction. Do we ever put federal estimated payments as an itemized deduction?
No.
No. What are your itemized deductions? Refresh my memory. We have medical expenses, and what's the next category?
State
right? Another
taxes. Oh,
taxes, and what else?
real estate.
That's it. State taxes that they take out of your paycheck, state and local taxes, and real estate taxes. That's it. Federal income taxes do not go there. Federal income taxes go after you figure out the tax liability. You don't get an AGI deduction for that either. It goes after you figure out the tax liability. This one is pretty straightforward. There's no credits, and no dependents, so it actually made it easy. Does that answer your question? Was that Matt? I think so, or somebody. Okay. Any questions on this one? Again, we're going to walk through more problems like this to get you more in the practice, but like I said, the practice has to come from your end. You still have to, want to do the practice on your own. What else? No questions on this? Again, the quiz is going to be open tomorrow. Same format, multiple choice questions, and the latest you can submit it by, again, it's a time quiz, 30 minutes to complete it. The latest you'll be able, we're going to review it next week. So at 5:30 next week, as soon as we get started, we're going to review it. It's going to go by faster because you'll have more practice. You will have to do some of these computations. So just, do practice on your own. The final quiz is again already up. The final quiz, which is your take-home quiz, and that's going to be due the week or the session before the final. Midterm, I emailed the midterm to you along with the answer key. I'm not going to go over that. You need to do that on your own. Since you have a blank exam, I encourage you for practice, act like you're taking the midterm exam over again. Then compare your answers to my answers until you get the same answers. Again, if you're still struggling with some of the important concepts. Again, as I mentioned, several times, use the midterm to help you prepare for the final. Use the midterm to help you prepare for the final. Again, use the midterm to help you prepare for the final. That's important to think about. Again, I want you guys to take a look at it. The final is going to be here before you know it. It's, again, only a couple weeks away. We only have a couple more sessions. Any questions on this stuff or any other stuff before we move on? No? All right, so take a picture of this or whatever you need to do. I don't know how you can save it. Like do a snap picture, screenshot. Think that would work.
I have a question,
Go ahead.
and it's about the midterm. You know, just to make it clear, like for the child tax credit, it has to be 17 years old younger, right?
Under
If-
17. Under 17.
yes. So
Not
if
17
it's
or under 17.
under 17, okay. And if it's younger than 23 and full-time college student, it only qualifies for the qualified relative credit, right?
There is no qualifying relative credit. It's a
I
credit for
mean,
other dependents.
dependent. Yes, dependent.
Again, it's the credit for the other the dependent credit. Right. The child tax credit is for anybody under the age of 17. That's related to you. I shouldn't say anybody under the age of 17. That person has to be related to you. Because think about this. I guess that brings up another important question. If the person's related to you and they're 16, again, it's your son, your daughter, then it's child tax credit. But what if it's your cousin that lives with you for the whole year? Can you still claim your cousin that's 16 years old? Can you claim a friend? Just think about that for a second. What credit would they get? It's not again, if you think about it, the child has to be yours. So on that, it'll be the $500 credit.
Okay, and it has to make less than $4,500
For which one?
for the qualifying dependent.
Well, it depends on which questions you're asking. Qualifying child and qualifying relative has two different set of rules.
Yes, the qualifying relative, like in the midterm, the Homer Simpson example, how Bart made, I think he made $4,500.
He made too much money.
Yes, so that's why he wouldn't qualify, right?
Yeah, he wouldn't
For the
qualify at all for either of the credits.
Okay.
Yeah, just for that. Again, I want you to get in the habit of applying the qualifying child test first, under 17 and or under 19, and then if that doesn't work, then you're right in doing the qualifying relative test. First test, you identify it right there. Gross income has to be less than whatever that exemption amount is, the 4,250, whatever it is. If that test is failed, then you don't need to go any further. You can't claim that person as a dependent. Period. It's clear as that.
Okay, thank you.
And even with that would be something that the IRS would catch right away. That's if their wages or something that's reported to the IRS. If the income is more than the exemption amount, they're just going to automatically adjust it. Again, when they file your return, it's not going to get adjusted there. It's going to be adjusted through notices. So if that's the case. But yeah, gross income test and the qualifying relative test, that's what you got to apply first. Okay, let's move
I have
on.
a really quick question. Just kind of, did you say that the next quiz the take-home quiz is already up? Where is it on Brightspace?
Assessments.
Under assessments? Okay.
Assessments, and there should be assignments, quiz 3.
Okay.
Do you see it?
Yeah. So that's the take-home.
Yeah, there should be a document, a Word document.
I'm looking now. Yep, I see it. Thank you.
Okay, yeah, that's the one that start working on that. Well, after you do the quiz, focus on the next quiz first. We'll start working on that, and then we're going to do that soon.
So that one's kind of like practice for the final.
Yes, yeah.
Okay.
Yeah, that's a good way to practice. But of course, you're gonna review everything else. But good practice for the final.
Yeah. Okay. Thanks.
All right, let's again. We're gonna do a quick review of stuff we covered last week. Again, business expenses. We talked about NOLs. We talked about self-employment tax. Here's the deductions for self-employed individuals. Quick overview. Again, remember, must be ordinary and necessary according to Section 162. Remember the non-deductible items. Remember, charity is not a business expense. It's an itemized deduction. It's a personal expense. Not deductible political contribution, lobbying contributions, and so forth. However, like on the exam, I'm not going to tell you clearly it's a lobbying contribution or it's a political contribution. You're going to be given enough information for you to be able to ascertain what it is. You got to use your analytical skills. Again, I'm not going to tell you if it's lobbying or political contribution, but there'll be enough language for you to know what's what. Entertainment is not deductible. Meals is deductible up to 50%. Some of these are that's part of Schedule C. In addition to the Schedule C items, business deductions, we talk about these other deductions that we started talking about already. 1/2 of self-employment tax, that's outside of, once you figure out the Schedule C net income, you do 1/2 of the self-employment tax. We covered that. Health insurance premiums, but that's limited to net income. If there's no net income, then it just goes directly as Schedule A as an itemized deduction. Otherwise, it's a deduction for AGI. SEP contribution, that's 20% of net income, or more specifically, 25%, but we're using 20%. This number is indexed each year, so $56,000 is a lot more than what you can put into an IRA up to that amount, but there's limit of the 20%. Deduction on qualified business income, that's new as part of the Tax Cuts and Jobs Act, very underused deduction, because some people, those rules that we just walked through right now, those steps, I think a lot of people don't do those steps because it seems complicated, but it really isn't. But you saw in our problem, that's a $3,000 deduction that if they're not taking it, they're leaving it, for some, just out there. The IRS is not going to tell you what to deduct. You got to put those deductions on your tax return. But if you don't claim it, they're not going to tell you, oh, by the way, you missed this deduction. You got to make that determination. The deduction on qualified business income, that's a deduction from AGI. Now, again, we talked about this before. We're not going to do this anymore or do more problems. Let's talk about depreciation. Again, quick overview on depreciation. Personal T, that's machinery, equipment, furniture, autos used in business operations, not to be confused with personal use assets. This is just personal T. Non-current operating assets. Real T, non-current operating assets that are real estate. That also includes land. So we talked about the different conventions. The default convention for personal T is half-year convention, except when more than 40% of your personal T assets are placed in the last quarter. Then mid-quarter convention applies. Both conventions use a modified accelerated cost recovery system. Oh, by the way, since we're on that topic, straight line rate for 5 years is what? 1 divided by 5, right? What does that equal? 20%, right? Right? Straight line rate is 20%, right? Is that right? I think so, right? Double declining balance rate is double SL rate, right? Which equals 40%, right? Makers is a modified accelerated cost recovery system. So this is the way it works. It starts out here, double declining balance. Eventually, it's a bit tricky the way it works. And then eventually it switches over to here, towards the latter part of the years, or the latter part of the life. But it starts out here. You guys remember that 20% for a 5-year asset? Remember I told you, I'm going to show you how they came up with 20%? Under the double declining rate, it's 40% of the remaining carrying value, right? 40, not the depreciable base, the remaining carrying value. But that's covered in more detail in your accounting class. But it's going to be 40% of the remaining carrying value, right? What's half of 40%? Come on, you guys don't need a calculator for this. What's half of 40%? 20%. That 20% is the first year for a 5-year asset. The percentage for the first year for a 5-year asset. That's how they came up with the 20%. You could do the same thing with a 7-year asset, 1 divided by 7, and apply the rule that way. That's how they got to the 14.29%. Again, and then it switches over to straight line going forward. But that's, you don't need to know that because the tables are provided, but I do want you to understand how it works. Now, regarding real estate has what's called mid-month convention, which we covered already. Residential real estate, 27.5 years. Non-residential real estate is going to be 39 years. This part should be taken out. So we talked about bonus depreciation. Again, unless I tell you otherwise, apply bonus depreciation first. It's 100% for a couple more years. It may get extended or not. I'm not sure yet. So you can use up to 100% of the personal TS. It doesn't apply to fixed assets. So that's actually a good deduction. Instead of depreciating over 5 years or 7 years, 100% the first year would work. Now, this is new section, well, not new, section 179 is actually a way to, similar to bonus depreciation, you can deduct up to 100% of your fixed assets for personal T, not real estate. And these two are very similar. Except for section 179, this has been increased for several years. It used to be like $500,000 a couple years ago. Now it's up to $1 million or $1,020,000. So the most you can deduct is up to $1,020,000. It was $1 million in 2018. I think I'm going to use the million from 2018 in my problem. So that's where we got the $1 million. It starts to phase out dollar for a dollar when it exceeds 2,550,000. Completely phases out at 3,570,000. By the way, somebody do the math real quick. The difference between these two numbers should be the 1,020,000. Should be. There's really no way around it. You know how we did when we talked about the startup expenses, the way it works, if it's in excess of $50,000, you don't deduct $5,000, it gets reduced dollar for dollar by that amount. Remember that? Same principle applies here, except the thresholds are higher. The threshold over here is 2.5 million. So once it exceeds that threshold, this $1 million gets decreased dollar for dollar. So look at these thresholds. These thresholds are actually pretty high. So that's limiting only middle businesses, small businesses. So it's trying to take out the big businesses, which is sort of the whole point. I'll rule against this. You cannot use a section 179 to create a net operating loss. You can't use section 179 to create a net operating loss. I'm going to say it again. You cannot utilize section 179 to generate a net operating loss. However, you could use bonus depreciation to generate a net operating loss. You can use regular depreciation to generate a net operating loss. And I'll say this again. You can use bonus depreciation to generate a net operating loss. That being said, because section 179 has limitations, wouldn't it be better off for the taxpayer to at least utilize some of the bonus depreciation to the extent that they can use it? There's hardly any limitations here, and it's up to 100%. Bonus depreciation is actually it's more popular now because it doesn't have any limitations. But bonus depreciation has been around for years. The numbers have been different. Now, why is section 179 there? It's still there because there are some benefits to it. I'm going to use section 179 to find a way to get out of mid-quarter convention, and that's going to be my problem that I'm going to go over in a few minutes. But understanding the rules. Now, this is something I talked about last week regarding the passenger automobiles. The limitations went up on the depreciation per year. I wanted you to take a look at what they have in their to the previous year prior to the Tax Cuts and Jobs Act, so you guys can see how it looks. It's a lot favorable right now. That's it for depreciation items. Any questions on depreciation? No questions? Okay. Let's do that problem. Okay, let me share the problem. Okay, remember the additional problems that we've been going over? I think we're almost done with them. I tell you what, after today's session, we will be done with these problems, but not with the next problems. With the problems labeled additional problems, tax deduction problems, we'll be done with those today. So let's sort of do a quick review of these. We did the NOL problem, right? We did that last week. So this one is crossed out, right? This is the one we're going to do right now. So this is for 2018. So the maximum amount is going to be $1 million for each year, instead of the 1,020,000, or it's slightly. I'm going to use the number for 2018, not the number for 2019. This is the one we're going to do right now. Rental activities. We're going to do this one right now as well in a few minutes once we cover chapter, the next section. This one we already did, vacation home. So we only got 2 more to do. This one and this one. All right, so let's sort of walk with the facts. J. Pacheco purchased the following assets in 2018. They're both 5-year assets, one in February, one in November. November is the 3rd quarter. More than 50% of the assets are placed in the last quarter. Which convention are we going to use? I'll give you a hint. More than 40%. I said 50% for a reason, because it is 50%. That's more than 40%. But 50%, which is more than 40%, is going to be placed in the last quarter. What convention are we going to use? What do you guys think? Just by me telling you that. You guys should all know this. Mid-quarter convention. So here's the mid-quarter convention, and I'll go back to the tables in a few minutes. You guys see the answer? Okay, the first answer, I'm gonna hide these real quick, and I'll unhide them. Okay, the first answer is pretty straightforward. Again, I'm using 1,200,000 in the last quarter. 50% is more than 40%. Mid-quarter applies. Now, those percentages. Remember the percentages that I told you guys to look at? It wasn't tax planning, right? Tax planning section. We're gonna look at those percentages again. Come on. Okay, here we are. Here we go. All right, you see these percentages? We're gonna do the percentages on the bottom. It's a 5-year asset, so we're gonna use this section, 5-year assets, right? So 5% for the last quarter, right? And February was in the 1st quarter, right? So 35% for one of them and 5% for another one, right? So keep in mind, it depends on which one. Okay. Again, the one placed in service in February, that's 35%, which is 420,000, right? The one placed in service in the last quarter is 5%, and then we get $60,000, right? So total depreciation, 480,000. Any questions so far on this part? No questions? All right, we're going to move on to the second part. So that answers question A. So question B, going back to the problem. Question A, again, basic depreciation. They're not taking bonus or section 179. Mid-quarter applies because more than 40% are placed in the last quarter, so we're using mid-quarter for everything, right? B, ignoring bonus depreciation, section 179 is going to be used in the 1st quarter. That's letter B. And then letter C, section 179 is going to be used in the last quarter, and then we're going to try to figure out which one is better. Let's apply the section 179 in the 1st quarter. Again, I'm using the maximum amount for 2018, which was $1 million, not the 1,020,000, which is what they have now in 2019. So I'm using $1 million, right? So of the $1,200,000, I'm deducting $1 million right away to the extent that I have enough income to cover it. If I'm deducting $1 million, how much do I have left? $200,000. That's whatever my recovery base is. Now let's take a look at the percentages. $200,000 in the 1st quarter, right? $1,200,000 in the last quarter. That actually made it worse. That's 86% of the total assets placed in the last quarter. It did give more depreciation because you're using section 179 automatic deduction. So that's $1 million. but mid-quarter still applies. This is still a lot more, $1,130,000 than 480. So it's still a lot more than just using regular depreciation. Everybody okay with that part, right? So what happens if I use the section 179 in the in the last quarter? Keep in mind that the last quarter is what triggers the mid-quarter convention. First quarter didn't work, it just made it worse. But I'm going to use section 179 in the last quarter. So that flips these numbers, right? $200,000 in the last quarter, 1.2 million in the first quarter. 14% is less than 40%. What convention do I use now? I'll give you a hint. I have the answer right there. You guys understand why we're using half-year convention now? Because we took out the goal for this problem is utilizing section 179 to get out of mid-quarter convention. Completely allowed. It's not something that you're doing against tax law. This is using, tax law to your advantage. It takes them out of mid-quarter convention. It maximizes depreciation. So now we got 240 for the first year, 40,000 for the second year, plus the section 179. This gives you the most depreciation. Use it in the last quarter. If you use it in the last quarter, it reduces the basis that you're putting in the last quarter. Hence, it can take you out of section or take you out of mid-quarter convention. You can apply bonus depreciation in the same fashion. Just keep that in mind. Bonus depreciation is up to 100%, but it's at the taxpayer's discretion. Same principle applies here. You can use bonus depreciation all in the last quarter, and then you're not in the mid-quarter convention, or you could use section 179. Either way works.
All right.
But keep in mind that bonus depreciation is not always around. Section 179 has always been around and will continue to be around. Section 179 is a good tool to use, again, to depreciate more of personal T assets and to get them out of mid-quarter convention. It maximizes depreciation.
I had a question about 179. Would it be possible to do the $1 million expense? Do you have to attribute it to one event, or can I do like partial, I don't know, enough to not trigger the 40,000? Like, let's say I will make it so that I backload it. So I'll do like a third of it for the first quarter and 2/3 of it for the second quarter. So
you can do that. Yeah, you can do that.
Okay.
Yeah, that's actually a good question. The question is, the maximum amount that you can use is $1 million, or whatever it is for that year. 2019 is $1,020,000. I don't quote me on the 2020. I don't know that number off the top of my head. It's about $1 million and change. But whatever that amount is, yeah, you can spread it apart as long as it doesn't exceed that amount. So yeah, I guess you could take as long as most of it under that tax planning strategy. If you're going to do it that way, most of it has to be in the last quarter. Right here, I just applied 100%. But I think you understand the principle since you're already getting it. If we're going to apply most of it, or if not all of it in the last quarter, it's going to take them out of the mid-quarter convention. Yes. You can spread them apart. You can use some of it in the first quarter, second quarter, and so forth. Keep in mind, this is not a decision you got to make during the year. This is a decision you make during the time that you file your taxes. Because keep in mind that this has limitations. It cannot create a net loss. So you really don't know where you're at and how much you can actually use until the end of the year anyway. So just keep that in mind. So this is a good tool to use. You don't have to use it during the year. Again, for accounting purposes, it's totally different. You're doing something else for accounting. This is tax related. This is total, different animal. What you do in accounting is not the same thing you do for taxes. Speaking of which, is any of this covered in any of your accounting classes? No. Double declining balance straight line is, but in terms of section 179, that isn't, because that's specifically a tax concept, a tax rule. I guess you could say somewhat like a loophole. I guess it is a loophole. Speaking of which, and this is something that I've sort of been struggling with. What is a loophole? And I'm asking you guys, what is a loophole? How can you define a loophole? Honestly, I really do not have a clear definition. What is a loophole? Is
a legally exploitable route to take?
It's
a loophole.
It's a legally a valid method for doing something that goes against what was intended by the law. So it's using the law as written as opposed to as intended.
Yeah, I like that definition. I like that definition. You're using it as, well, yeah, that makes sense. But this one is not a loophole because you're using it the way it's intended. To maximize depreciation. This is not necessarily a loophole in a way. There are loopholes out there, but there aren't many that people that think, accountants know all these loopholes, CPA. It doesn't really work that way. There are some think of the loophole that I just talked about now. We talked about the excess business losses. Wouldn't you say that's a loophole now? If you think about it, before they try to curb tax shelters by only limiting the business losses up to 250 or 500,000 for married. Now that's out. By them repealing that code, that provision, doesn't that create a loophole for taxpayers? See, that's the part where I'm thinking of, because they took the whole law, they repealed the whole law. Is it really creating a loophole because it's not there? Does the absence of a law create a loophole? I don't know. I'm just having, especially with that particular concept. I want to say people that have losses, if they utilize the losses, they're using a loophole. But then that law doesn't really exist, so it's not anymore, at least. So it's not really a loophole. Do you see my dilemma? Because the excess business loss has been repealed, is it really a loophole? I guess I'm just, it's just semantics that I'm just thinking of. It's that I don't know if I should call that particular one a loophole. So I don't know.
I would think loophole would not be related to something being repealed. It would be initially that either then gets like plugged or never ends up getting plugged.
An existing law. Okay, I'll take that. So speaking of loopholes, are you guys ready to talk about more loopholes? We don't talk about loopholes here. We talk about tax planning, tax strategies, and how to save clients money on taxes. So we're going to move on to the next couple of chapters. We are going to do questions from these chapters. Well, I want to get started to the itemized deduction chapters and the passive activity losses. And then next session on Wednesday, we'll do comprehensive review up until chapter 10, which would be chapter 11, which would be mostly 10. Chapter 11, we're not really going to touch too much on it, but up to chapter 10, which is itemized deduction. Chapter 11 deals with personal losses and active passive activity losses. All right, so next, itemized deductions. This is where, or personal deductions is what we're going to talk about. So we actually made a lot of progress so far. Again, we talked about tax depreciation, net operating losses today, self-employment taxpayers, qualified business income deduction. We accomplished all those today. Again, we're going to cover that in more detail in the next, couple sessions as well. We're going to talk about itemized deductions in more detail today. And we're going to talk about investor losses today. We're going to end with that real estate problem with Homer and Simpson today. And that's going to be the last problem. I don't think we'll get into the problems from the book today. We'll get into that next week. This is the article that I told you guys about if you want to read it. Let me see if the link still works. Yeah, it should still work. This is from 2016. Again, goes over a lot of the stuff that we're going to go over today, material participation, so forth. Here's the NOL rules. Yeah, it's still there. I should write something else. What else should I write about? I'll find something else to write about. Take a look at that article. It's a good article to look at. All right, so we have tax deductions, itemized deductions. Here we are, the itemized deductions. I think for the most part, everybody gets it. There's, we've been covering itemized deductions since day one. So this is more of a review. But we're going to get into more detail of some of the itemized deduction. Again, here's the categories: medical expenses, taxes, interest, charities, personal casualty death losses for only certain taxpayers, and miscellaneous deduction with no AGI floor. Now, again, to understand, what's not available anymore, I included this part in there. Interest on home equity loans. That's sort of been eliminated, sort of, to some extent. I'll talk about how you can actually use the tax code to your advantage. I guess this would be a loophole, what I'm going to explain to you in a few minutes. Personal casualty theft losses not in a federal disaster area. That's been eliminated. Miscellaneous deduction subject to the 2% AGI floor. So that's your employee business expenses. A lot of people are, now, especially individuals that have a home office. Again, employees that have a home office won't be able to deduct the home office expense. Think about that. Attorney fees that we talk about that's related to production of income, like discrimination cases, injury cases, you don't deduct attorney fees anymore. Job hunting expenses used to be deductible. Investment expenses used to be deductible. Hobby expenses, again, limited to income, that used to be deductible. Safe deposit box used to be deductible. Tax preparation fee used to be deductible. None of those items are deductible anymore. This whole section has been temporarily eliminated until 2025. Well, until December 31st, 2025, or unless Congress changes it. Now, in terms of medical expenses, what can you deduct for medical expenses? Qualifying expenses are deductible if paid for the taxpayer, taxpayer spouse, or the dependent. And that includes any insurance reimbursement. So again, if your insurance covers it, you don't include the insurance. It includes all your out-of-pocket money, not what you get reimbursed, your out-of-pocket money, your co-payments, your prescriptions that you pay with out-of-pocket, not what the insurance covers. In terms of what's included, medical insurance premiums. Self-employed individuals can take that as an AGI deduction limited to your net income. So just keep that in mind. If they have a net loss, then it just goes as an itemized deduction. So what kind of medical expenses? It has to be a licensed medical professional. So visit to doctors, dentists, eye doctors. Again, it has to be, medical profession. Required surgery will work. Elective surgery would not work. So again, requires surgery. I'm getting LASIK surgery to improve my vision. That would be required surgery, corrective surgery. That would work. Let's say I don't like the way my nose looks, and I want to get my nose done. That's elective surgery, not a deduction. Again, the keyword on elective surgery. But let's say I was involved in a car accident and I got, severely, I was third-degree burns. My face was severely damaged, and I was required to get reconstructive surgery. Would that be a deduction then? Again, in that case, it's not elective. That's more required surgery because it's a result of an injury. Then that would be a deduction. But I'm sure you get the gist of a elective surgery. I'm just cosmetic surgery just to improve my, ego, so to speak. That's not deductible, not for medical expenses. Prescription medication is deductible. Over-the-counter medication is not deductible. So if you buy Advil, that's not deductible. But if you get a prescription for ibuprofen, then that's deductible. Recreational drugs, not deductible. Yes, that includes cannabis. So that wouldn't qualify. So speaking of which, let's think about this for a second. Now, in Illinois, well, actually, it's true for pretty much all states that have medicinal cannabis, medical marijuana. You have to get a doctor sign off on it for whatever condition you have. It works a little bit different in Illinois. But let's say the doctor charges you a couple $100. Is that considered a medical expense? What do you guys think? I don't have the answer for that. I would guess because it's a licensed professional and that person is giving you medical advice, I would guess the co-payment that you pay to the doctor should be because that the doctor is giving you, medical advice. However, if that medical advice consists of prescribing cannabis, is that deductible? Unfortunately, yeah, cannabis is not deductible right now. They're relying a couple. Well, they used to rely on a couple old provisions. There was an old revenue ruling from the 70s that they used to rely on that said recreational drugs are not deductible, period. And now it's been, updated, and still recreational drugs are not included. So just something to think about. Cannabis drugs, even though it's used for medical purposes in a lot of states, the cost of marijuana for recreational purposes is not deductible. But in terms of the cost of seeing that doctor, I don't know the position on that. I would say that that would be included as a physician advice. I don't see why not. But the cannabis, medical cannabis, would not count. Oh, speaking of which, every now and then Congress tries to pass something similar to that. They haven't been successful. Transportation to see your doctor, to see your physician, it's 20 cents per mile, or the actual expenses. Again, you can't take both. You can't take the gas plus the mileage, or the whatever transportation on the L or the CTA. It's either or. You can't take both. There are some capital improvements that can be added as medical if it's required medical. So if somebody in your house requires a ramp or modified, in that case, some of it will be deductible. But there's limitations on that. There's limitations on to the extent that it increases the value. So there are some limitations on that. Okay, so next section. Hold on one second. That's annoying. Somebody should turn off their alarm, right? Can you guys hear that? Can you guys hear their alarm? Oh,
Yep.
never mind.
Yes.
Yeah, well, I don't. And that guy's outside. He's outside in front of his car, and he's letting his alarm go off. I guess he forgot to turn it off or how to use it. All right, let's go back to next section. Taxes. What taxes are deductible? Well, the self-employment taxes can be deducted as an AGI deduction, not an itemized deduction. So that's a deduction as a deduction for AGI. Any other taxes that's related to business are deduction as part of Schedule C deductions for AGI. So that includes like payroll taxes. So if you have payroll taxes, you have employees, any payroll taxes that you pay, that's deductible. State franchise tax, Illinois changed the rules on franchise tax now. I have payroll taxes twice. Real estate taxes, again, any taxes related to your business, that's a deduction, part of Schedule C, not an itemized deduction. The following items are itemized deductions. These are part of Schedule A deductions. Real estate taxes on your personal property, real estate taxes on your vacation home, real estate taxes on your rental property, that's a deduction for AGI. Deduction on the personal property from AGI, itemized deduction. State income tax. Again, any estimated payments or any payments that you've made with extensions or sales tax, and in those states that don't have an income tax, you get that as a deduction. Personal property tax. Illinois doesn't have a personal property tax. They have real estate taxes, but not personal property taxes. These are taxes that are based on the value of the property. Again, Illinois doesn't have only on real estate. Foreign taxes can be included in this group, but is much better to be included as a credit. So these are taxes that are paid for. Again, somebody has I have an investment account in, let's say, Spain, for example. I pay taxes in Spain, so I get either I claim it as a credit for the taxes that I'm paying in Spain, or claim it as a deduction, as an itemized deduction. Usually better as an itemized deduction. Limitation here in this particular section is $10,000. That's part of the Tax Cuts and Jobs Act. Half of that, if you marry filing, is separate. Interest. The only interest that you can deduct right now for home is your home equity interest. However, if you have a mortgage on a warehouse that you use for business purposes, then that's a business deduction for AGI, right? If you have a mortgage on a rental property that's 100% rental, deduction for AGI, not from AGI. Again, when it's a personal item, it's deduction from AGI, itemized deduction. That's what we're going to talk about today. So what is a home mortgage interest. This is what's called acquisition indebtedness. Acquisition indebtedness. I'll say that again, acquisition indebtedness, because that term is used a lot. And this is on the first and second home. Interest on a third home, even if it's personal, is not deductible. Wait, well, let's go over here on taxes. Taxes don't have limitation. Interest does. It's first and second home. If you have three personal properties, you could only take the interest on the first two, not the third property. But if you have on the third property, you can take taxes. There's no limitation. And first, second home. Prior to the Tax Cuts and Jobs Act, the limitation on the balance was up to 1.1 million. Half of that if you marry filing separate. So it only covers your principal balance up to that amount. Anything over that is not deductible. So again, if you have a mortgage, for example, you have a mortgage, you buy a mansion that's worth $2 million, the interest that's deductible is only going to be the interest that's deductible on the first 1.5 million. So you're going to take 1.5 million divided by 2 million times whatever the interest rate is. That's going to be the deductible portion. As far as the Tax Cuts and Jobs Act, that floor went down on new acquisition indebtedness to 750,000, 370,000 for married filing separate. So what is considered acquisition indebtedness? Acquisition indebtedness is debt that is incurred in buying, constructing, or substantially improving the taxpayer's principal residence and secured by the home. I'll read the first part again. It's incurred in buying, constructing, or substantially improving the taxpayer's principal residence. You guys see how home equity interest will fit this definition? Home equity interest is not deductible except when the home equity is considered acquisition indebtedness. In other words, they got to use the home equity proceeds to do remodeling in their house. If they take out a home equity loan to pay off student loans, or if they take out a home equity loan to pay off student loans, I just said that twice. Credit cards, student loans, or anything other that's not related to anything related to remodeling in the house, that's not deductible. Acquisition indebtedness, and I'll read this again. It's incurred in buying, constructing, or substantially improving the taxpayer's principal residence. So home equity interest can still qualify. By the way, that section has always been in there. Now they're actually more specific on it. When people say home equity interest is not deductible, that's sort of true. I guess the loophole here would be not necessarily, well, I guess it is a loophole. So long as it's used to substantially improve, remodel your residence, then it is deductible. Let's talk about points. What are points? Points are prepaid interest. So how are prepaid interest deductible? Well, it depends on how you pay the points. If you pay the points when you acquire the building, again, on acquisition, it's fully deductible. If you pay the points to refinance, then you just amortize it over the life of the loan. Again, if you buy when you acquire the building, it's deductible the first year. And then if you pay it to refinance, it's amortized over the life of the loan. Investment interest, that's limited to investment income. If you take out a loan to buy municipal bond interest, then the interest on that loan is not deductible because you have tax exempt interest. Something to keep in mind. Student loan interest. By the way, student loan interest is not an itemized deduction, but it is a deduction for AGI, not an itemized deduction. Deduction for AGI. I included that in here because it's part of the discussion. So it's limited to up to 2,500, but it starts to phase out when the AGI starts exceeding 70,000 to 85,000 for single. Double that for married filing jointly. Married filing separate is a different example. There's no limitation, or no, it starts to phase out right away. So think about that and think about the professions that affects. Now let's talk about charity. What type of charity can I deduct? Remember, charity is not a business expense, even if it's paid out of the business. It's a personal expense. But how can we treat these deductions? Well, the qualifying contribution must be paid in cash or property to a qualifying charitable organization, 501c3 organizations. Donation of services are not deductible. However, if I donate my services and I incur travel, the direct cost would be deductible. I can deduct my mileage and other expenses. So let's say I'm doing a presentation in front of a church to talk about personal finances, and let's say I'm actually creating handout materials, then the cost of the handout materials will be a charitable donation. The cost to travel to that location would be a charitable donation. If I pay parking, that would be deductible. But the time of my service, my presentation, the value of my service is not deductible. How much can I claim? What's the most that I can claim for charity? I'm sure you guys may get that question a lot. Well, the maximum amount is 60% of your adjusted gross income. That's the maximum amount that you can claim. So if somebody ever asks you that question, always come up to them, well, you can claim up to 60% of your income, but it's all whatever they can substantiate. Just keep that in mind. So what happens if they exceed the floor? I mean, the ceiling. Anything after the ceiling, the excess would get carried forward for up to 5 years. For tax years before January 1st, 2018, and maybe 2025, the ceiling amount is 50%. So again, replace that with 50% instead of 60%. 60% is the Tax Cuts and Jobs Act number. So how does the limit work? It's a 60% on total donations in total, but it's split into different categories. Now, I'm not going to test you on these different well, I don't want you to understand that the ordering rules, the way it works, but on the specifics, because it even gets more specific than that. I'm giving you the general specifics. It's a lower amount for private foundations. Keep that in mind. Lower amount for private foundations. These are the general percentages. 60% overall. Cash donations, again, 60%, that's the limit. General property, so I donate furniture. I donate clothes. Well, then I'm going to take the lesser of the cost or the fair market value. So in that case, it's going to be the fair market value. Usually when somebody donates clothes, they should get a receipt. Always ask for a receipt. In terms of how much the value of the clothes would be, that you could do more specific. Look up the value of the clothes, or what's done in practice, take 25% of the original cost. Never use the cost. If they paid $1,000 for furniture, you're not going to deduct $1,000. Take 25% of it, 20% of it. That's about what the fair market value would be. Do not take the cost. It's the lesser of the two. What about appreciated property? This goes when they're donating stock, when they're donating land, something that appreciates in value. The limit is 30% of your adjusted gross income, or whatever is left over to reach the 60% floor. I mean, ceiling again. It's 30% ceiling amount on the adjusted gross income, or whatever you need to reach that 60% overall floor after cash donations. I do mention the private donations have a lower ceiling. It's about 20%. Um, that determination letter will tell you what percentage to use. So keep that in mind. These expenses are no longer in the books. Miscellaneous expenses are temporarily suspended. So what expenses on the miscellaneous expenses are deductible? These do not have floor. Gambling are deductible to the extent of gambling income. Unrecovered portion of your annuity, the year of death. So you guys know how annuities work. They're insurance products. You make a certain amount as an investment. You expect to recover that investment plus more. You win. But what if you don't recover all your investment and you happen to die before the insurance company pays you? Well, you lose. The unrecovered portion, the unrecovered investment, it's a deduction as an itemized deduction. Very few people even think about this because they don't even think about it as a deduction. But you should ask. You should ask if somebody dies, hey, do they have any annuities? There's still a deduction, some unrecovered basis that they can deduct. Federal and state taxes paid on income in respect of a decedent, that's either deduction here or deduction on the state tax return that I briefly mentioned. Those are your itemized deductions. That's it. Let's talk about passive activities, investor losses. This is your next chapter. Remember the three types of income. There's active income, materially participation, earned income, that's first category, portfolio income, investment income, dividends, and so forth. And then we have what we're covering today, passive income. Again, started several years ago to curb tax shelters. Take a look at the article. I'll give you some more information on that. So again, section 465 and section 469 were set in place to curb some of these tax shelters. There was a lot of loopholes out there. This is what people would do. I'm going to invest X amount of dollars and then claim a loss. Well, let's say I invest, think about this logically. I'm going to invest $1 and somehow I'm going to end up with a $50,000 loss. Doesn't that seem like a loophole? It used to be, and I'm exaggerating it a bit, but just I want you to understand the context behind it. I invest $1, but somehow I'm deducting $50,000. Well, they try to curb that with several rules. First rule is at risk amount, $465. I mean, section 465. In my example, what is the maximum amount that I can lose? What's the maximum amount that I stand to lose? If I'm putting in $1 and my share loss is $50,000, what do I have stand to lose? Just that $1, right? So my loss, to the extent that I have at risk amount, is just that $1. That's what I want you to understand. I cannot deduct a full $50,000 because I only put in $1,000. That's it. I only stand to lose a dollar or $1,000, whatever it may be. That's the most I can lose. That's the most I can deduct. Okay, that's the first rule, the first hurdle. How much do you put in? What's the most you can deduct? But there's several computations, especially when we're dealing with partnerships. You make adjustments during the year and S corporations, and this is the way it works. And I cover this in more detail in the corporate and entity class. But just so you can get an idea how it works, you start out with the initial amount that you invested, plus your share of profits, plus your share of tax-exempt income. If you add additional capital, that's in there as well. You subtract your share of losses. Non-deductible expenses are included in here. Dividends and draws are also subtraction. That is going to be your at-risk amount. Now, what I want you to note for this particular rule, there are additional amounts that can be increased by the share of recourse liability for partners in a partnership, and it can also be increased for a shareholder loan for a S corporation. So it depends on the circumstance. But just what I want you to get out of it, if I put in $1,000, that's the most I can lose, then that's the most I can deduct under this rule, section 465. Pretty straightforward, right? The most that I stand to lose is whatever I put in, plus or minus a couple adjustments. I'll go over some of these adjustments, just the basic overview, so you can understand it. But again, just follow the basic rule. The most that I stand to lose is the most that I can deduct. So that's rule number one, the first hurdle. Hurdle number two, section 469. So now I have enough to deduct. Can I deduct it? Well, the next question is, did you participate enough for it not to be considered a passive activity? In other words, did you materially participate? If you materially participate, then maybe you'll be able to take the deduction to the amount that you're, to the extent of the amount that you stand to lose. But if you did not materially participate, then you cannot take the deduction at all. Well, there's some exceptions to that. Let's cover the exceptions of passive activity losses under section 469. Section 469 does not allow any net passive losses. Passive losses can only offset passive income. So if I have passive income from one partnership and passive loss from another partnership, they can offset. Any disallowed losses are carried forward for the next year. Disallowed losses may be deducted when it's sold or when the person passes away. That's the only time you can deduct passive activity losses. So now we got two rules here that were set in place to curb some of these tax shelter rules. Rule number one, did the investor put in enough money? How much did the investor stand to lose? That's rule number one. Okay, they have enough money, they have enough to stand to lose. Second rule is, did they materially participate? Did they participate in the investment enough where it's not considered passive? Depending on the answer here, then they may be able to take the deduction. If it's a passive activity, they can only deduct passive losses against passive income. No net passive activity losses are allowed. Only the year that's allowed. So what is the question? The question is, what is a passive activity loss? An activity where material participation is not present. And I'm going to go over the rules in a few minutes. And again, the book gives you a lot of details on the passive activity rules. And this, by the way, this temporary regulation has been around for several years. I'm actually surprised this regulation has not been set as a final reg instead of temporary reg. Just a side note. Again, this regulation's been around for years. I don't know why they don't just say it's a final reg now. But that's a different issue altogether. Rental activities are considered passive by default, some exceptions below. So rental losses are disallowed with some exceptions. Well, let's go over the material participation rules first, and then we'll go over the rental loss rules. So here are the here are the rental loss rules. I'll go over that in a few, but let's go over the passive activity losses. Again, passive activity losses, material participation. The taxpayer has to participate in the business more than 500 hours. A self-employed individual participates more than 500 hours, right? Taxpayer participation in the activity is more than anybody else, substantially all the participation in the activity of all individuals, so more than anybody else. A self-employed individual is going to satisfy both of these rules. You just got to satisfy one. If you don't satisfy 1, 2, or 3, I mean 1 or 2, let's go with rule number 3. Rule number 3 actually sort of combines the first two rules. The participation is more than 100 hours, but not less than the participation from anybody else. So he or she participates more than anybody, and it's also more than 100 hours. So it has a combination of both. So again, that's it all depends. Rule number 4: the taxpayer's aggregate participation in all activities exceeds 500 hours. So in this particular, you got to make an election to aggregate all the activities. So this is how this particular rule will work. If somebody has multiple partnerships, multiple investments, multiple S corporation, multiple K1s, then number 4 may work, because all they have to do is participate in 500 hours in total, but they got to make an election to aggregate all the activities. As long as they participate 500 in total, in aggregate, it would work. And again, it has to be more than 100 hours during the year and so forth. Again, this is for the current year. If it's not met in the current year, you can actually meet it in the last years. 5 and 6 relate to previous years. 1, 2, 3, and 4 is the current year. So let's say they do not meet the test in the current year. Well, then you got to ask yourself, did they meet the material participation in 5 years out of 10 years in the past 10 years? Then yes. Then even though they don't meet the material participation in the current year, then it's considered if they met it in the last 5 out of the last 10 years. Or if it's a personal service corporation, again, accounting, law, architecture, material participation has to be present in any of the 3 years. And then the last rule is facts and circumstances, which is applied on a case-by-case basis. That's material participation. I'm not going to test you on these rules. I do want you to become familiar with these rules. Let's go over the rental losses. So rental losses. This is very common. I do want you to understand this. Rental losses are of personalty and realty are considered passive and therefore disallowed. But wait a minute, I heard that you can invest in real estate. It gives you a lot of deductions. It depends. By the way, I'm sure you heard all these seminars. Invest in real estate is going to give you a lot of deductions. Well, that's sort of true, sort of not true. Rental activities of real estate is passive. You cannot deduct passive losses. That's the part that these individuals that do these seminars forget to tell you about it. But they do tell you consult your tax advisor. We're not giving tax advice. Here, I'm giving you sort of tax advice. I'm just giving you the tax law. Rental losses or rental activities is passive. You can't take that deduction, except when you can. Active participation is different than material participation. But the exception applies. This is like the mom and pop exception. If you actively participate in your rental activity, meaning you're meeting your tenants, you're screening your tenants, then you can deduct up to $25,000 or whatever your loss is in that given year. Half of that if you're married, filing separate. Again, if your loss is $20,000, then you're not going to deduct $25,000. You'll deduct $20,000, whatever your loss is. If your loss is $10,000, you're not going to deduct $25,000. You're deducting what your loss is. Again, it's limited to half of that if you marry filing separate. But it starts to phase out. If your income is more than $100,000, it starts to phase out 50 cents or by 50 cents of the dollar over that amount. It completely phases out at 150,000 by 50 cents. So if you're at the middle, it's at 12,500. So again, modified adjusted gross income is rental, everything except rental losses before the floor. So let's just talk a little bit about this Maggie rule. So let's say my modified adjusted gross income before my loss was $80,000. Just on that rule alone, what can I deduct? What's the most that I can deduct? Up to $25,000, right? Or whatever my loss is. What if my modified adjusted gross income is $160,000? How much can I deduct then? Zero. It's all suspended. It all gets carried forward. That's what I want you to get out of it is if it's below the threshold, under $100,000, it's up to $25,000. Over the threshold is zero. All of it gets suspended. Everybody okay with me on that so far? Again, half of that for married filing separate. Now that's the exception to the rental losses that are considered passive. But there's also an exception to the exception. The exception to the exception is real estate professionals. By the way, you cannot just designate yourself to be a real estate professional and you're a real estate professional. No, it doesn't work that way. Just by having a real estate broker's license or real estate or any type of licensure, that doesn't make you a real estate professional by itself. You got to meet the definitions according to tax law. This is the definition according to tax law. More than 50% of your services are in real estate. So more than this is the first rule itself, it makes it hard for anybody that has a full-time job to be considered a real estate professional. Think about this for a second. If you're a full-time employee, you're working 2,000 hours in your job, about, right? How many hours would you have to work in the real estate activity for you to be considered a real estate professional? 2001, right? You guys get the math, right? I'm working total 4,000 hours, right? So I would have to work more than half of that in my real estate activities in order for me to be considered a real estate professional. Makes it hard, pretty much impossible for somebody to be a full-time employee and a real estate professional. And not only that, you got to meet the 750-hour test. More than 750 hours are in real estate and you materially participate in real estate. So what does this mean? If you are a real estate professional, you're able to deduct the entire loss at all of it. No limitation of it is deductible. For married filing jointly taxpayers, as long as either spouse meets the real estate professional test, they qualify. Well, let's see if we can apply this particular rule in a problem. Let me see if I have a problem in this particular tax deduction problem. Okay, here it is. All right, one thing I didn't mention in here, immaterially, so Simpsons actively participate in rental. I'll just say actively. So net loss is $50,000, right? Net loss is you guys see that, right? $50,000. You guys see that? How did I get to $50,000? $200,000 rental income minus $250,000 rental expenses, right? The modified adjusted gross income of $90,000, assuming they actively participate. Letter A, if they actively participate, what is the most that can deduct? Anybody want to volunteer an answer here? 25,000, right? The excess of 25,000 is carried forward for up. Well, I'll just carry forward. So actually, I don't like my explanation. My explanation is going to be more because they actively participated and their Maggie is less than $100,000, they can deduct up to they can deduct 25,000, right? Right? Any question with the first one? Okay, let's do letter B. Would your answer change if their Maggie was 160? What do you guys think? Because they actively participate and their Maggie is more than, what do you guys think for this one?
None
What
of
do you
it is
None of it
deductible then?
Yeah. More than, yeah, none of it is deductible. The entire loss of $50,000 is carry forward. Yeah, good point. Good forward. Letter C. Would your answer change to A? Well, let me change it a bit to A and C or B. Change if either. Yes. So, and if either Marge and Homer were considered real estate professionals, they will be able to deduct the entire loss regardless of their Maggie, right? Right?
I have a question. Where is it deducted from? Is it deducted from their income?
Hmm?
Like at what section? It's like, is it a deduction for AGI from? I'm just trying to figure out where in the process they would deduct it.
Okay. What are your deductions from AGI?
Itemized or standard?
Okay. Do you have your answer now?
Maybe.
Well, you do. You should.
So it would be. So it'd be 4.
Yeah, the 4 AGI deduction.
Okay, sounds good.
Again, and if you're, I understand sometimes it's a bit tough struggling with where it goes. Just think of it that way. The best way that I can explain it: itemized deductions from AGI, standard deduction from AGI. If it's not part of an itemized deduction and that deduction is allowed, where is it deductible?
It's just 4 AGI.
For AGI.
Okay.
Remember, I also talk about this. This goes on Schedule E, so this would be a Schedule E item. So all the business deduction, then if you have a net loss, is a deduction for AGI. Deduction for AGI.
Okay.
So again,
Sounds
not
good.
yeah. So don't, if you think of it that way, if it's not part of a from AGI deduction, which are your itemized deductions, you know, and a qualified business income deduction, then it's a deduction for AGI if it's allowed. All right. So what are the requirements here? Anybody want to tell me the requirements? Who hasn't been participating today? Margaret, you've been quiet lately. What's the real estate professional rules? We can't hear you. I think.
Sorry, more than 50% of their overall services are performed in real estate.
So yeah, more than 50% of their time. So 50% of services are in real estate. Okay, good. Okay. More than what? That's another rule.
More than 750 hours in real estate activities.
And the other one is material participation in real estate. But if you think about it, if you read the first two are met, you materially participate in real estate. If you remember the material participation rules, just remember those two. But I guess if you want to, you know, do material participation in real estate, and that's it. Yeah, that's it for this one. Again, real estate is a good way there is some benefits from investing in real estate, and this is actually one. But the thing about people are misled when they say invest in real estate. It's going to give you a lot of deductions. But one of the parts that they don't even think about, let's say this person does meet the real estate professional or doesn't meet the real estate professional test, and they have a full-time job. This person makes again the $100,000. This is in total. So let's say two spouses. One spouse makes $80,000. The other spouse makes $80,000. And they have real estate activities, a couple of different rental properties. So together they're at $160,000. Can they deduct the rental losses on those facts alone? No. Their AGI is over $150,000. None of it is deductible. Everything is going to carry forward. That's the part that people tend to miss when they go to these seminars on investing in real estate. Again, do not get me wrong. Investing in real estate is, I do, understand real estate is an appreciable asset. It appreciates. You're always going to make money when you invest in real estate, but in terms of getting tax deduction, a lot of people are misled because of this, especially because of this. They hear you get a lot of deductions if you're real estate. Well, that's not always true. Mortgage interest, property taxes are deductible as a personal deduction. That's deductible. But what about as rental property? Well, it all depends. Remember, we talked about vacation home and how that applies. If it's a vacation home, then it's limited. You still offset it against your income, but it's limited, right? And then we talk about this rule. If it's not a vacation home, then it's a rental property. If it's a rental property, it's still limited because it's still passive. If it's passive, none of it is deductible except if they're actively participating. So just keep that in mind. So that limits a lot of individuals out, and this has been around for years. The $100,000, $150,000, those numbers have not been indexed. And I have a problem with that because it doesn't take that much. It could take two individuals. Again, let's say even if both individuals are making, $75,000, $70,000 each. That takes them, pretty much takes them over the $150,000 hurdle. It's something that's been in there that hasn't been fixed. Maybe it's by design. They don't want it to be fixed. They wanted to keep it, that way in terms of, real estate losses. That's all that I have for the real estate losses part of it. I think that's all the problems we have on these. Any questions? You guys want to take a screenshot of this real quick before I remove it? Okay, the last comment that I want to make is the last part of the chapter 8 notes. I mean the lecture notes. These are other losses that I want we've sort of already talked about these losses before. Again, this is more of we're reviewing other losses that are deductible for investors. Capital losses, remember they can deduct up to $3,000 or half of that from Mary Finally separate. You cannot deduct a capital loss if you sell your personal used car. A couple of you got that for some reason, deducted that on the midterm. Don't make that same mistake on the final. Losses on the sale of personal use assets are not allowed. Section 262 tells you that. Losses on other assets may be allowed, like on a stock, on a bond, it is allowed. But if it's a personal use asset, no, because Section 262 tells you it's not. However, if it's income, then you report it as income. That kind of makes sense. Small business stock, we talked a little bit about that as well. If it's a small business stock, first $50,000 or $100,000 is considered ordinary, and then the rest of it is the capital loss. We talked about that a couple of weeks ago. Worthless security, that's another loss. If it's the security becomes worthless, you'll be able to take the deduction the year that it becomes worthless. That's all that I have for the investor losses. So now we're up to chapter 11. So again, next session, we'll do the quiz. We're going to review the quiz first, do that before class. And then we'll do more problems. Next session, we're going to do more problems in chapters, the remaining chapters. I will do something in chapter 11, but mostly it's going to be 7, 8, 9, 10. And a lot of that stuff we already covered it. So even with 10, more of an overview on what's an itemized deduction. I think you're pretty we're pretty comfortable with that. Starting next week, we'll cover property transactions, which is the next set of problems from Brightspace, and that's going to be on the final. So the final is going to be, cumulative. Will include property transaction problems, and I will tell you which problems to focus on as we go over those problems in class. But again, right now we're up to date with everything we need to cover. We'll do chapter problems next session, and we will get started with property transaction, at least the overview next session. Next week we'll get into more detail with property transactions, and then again, before you know it, your research assignment will be due. Your tax return assignment will be due. Make sure you submit it in the portal on Brightspace. After 5:30 on that due date, you won't be able to submit it. Again, make sure you submit the projects by the due date. Any questions? Anything you guys want to talk about? Again, the due date on the research assignment. Your tax return project is due July 18th. Your research assignment is due July 20th. And look at the other dates for other information. Any questions? Any questions on anything we've covered? And anything else? Anything you guys have in mind? No questions? You guys have no questions. Come on, Matt. You always have a question. Or Dan.
All right, I'll ask a question. Are you gonna post our midterm, like where we can see our answers? I didn't see that available online.
I can't do that for some reason. I tried that and it doesn't post. It's weird. It only posts multiple choice answers, and I kept trying to post the answer. And it says written responses. You cannot post the actual answer. I'm like, well, that doesn't make any sense. There has to be a way, but it works for the multiple choice questions, but doesn't work for these type of questions. So I guess the only thing that I would tell you is going to be the same question. The order of the question is going to be different. I'm sure you have an idea of what. If you want me to go over your specific questions, we can go over it in more detail. But the scores are what the scores are. I'm not going to make any changes to your score, but I am willing to go over it, question by question. But the condition is you got to review the midterm that I gave you and be prepared to discuss it. If you're scheduling a meeting with me to go over the midterm or to go over your current standing, at the time of the meeting, I'm going to expect you to have already gone over the midterm, including your answers, and that way we can discuss on what your weak areas are and how can you improve your grade. If that's what if you're trying to meet with me to improve your grade and your current standing. The meeting is not to negotiate the score. The score is not going to change. The meeting is not to give you extra credit. As I mentioned before, I don't give extra credit. The meeting is just so I can provide you guidance and tips on how to improve your score. As I mentioned before, in terms of if you're coming in with me, to ask me if you should drop the class or not, that's not a decision that I need to make. That's a decision. Again, the only thing that I would say that you got the syllabus, there's still a lot of work to do. Just keep that in mind. It's not a total loss yet. But if you're not happy with the score or the result that you received so far, you got plenty of time to make changes to the way you're preparing for class. You got plenty of time for that. Again, you still got the final, you still got the next quiz to turn in, and then the next assessment, the research assignment, and the tax preparation assignment. So you got enough time to improve your grade. So just keep that in mind in terms of on the midterm. But again, yeah, the midterm I did send it to you. I was trying to get it available to you so you can compare your answers, but I can't find a way to do that on Brightspace. And in the actual class setting, I would give you your exam, and your answer key would be easier. But that's one of the things that's in my opinion is taken away from this format. It's actually more work from your end to try to figure out what was your answer, right? Right, Dan, that's what you're trying to figure out. So what did I put in this question? What did I,
Yeah, exactly.
And it's good. It's tough on your part from a student. You can look at my answers and you could probably say, well, I kind of remember saying something like that. But it's tough actually reviewing your answer. I don't know how let me ask around. There has to be a way. Let me ask around, see if there's a way to, you know, again, multiple choice questions it's easy, but not for short answer questions. I'll ask around to see if I can do that. But for the time being, do not expect me to, you know, make any changes. Use what I already gave you, the midterm and the answer key, and just look at the answer key, compare them. You know, start thinking of what your answers were.
I have a question,
Go ahead.
and it's from the midterm. For the filing status, there was a scenario where a couple, the guy didn't have kids, and he married, and the lady had a child. They got married like the last day of the year.
Okay.
They could file like filing jointly, but
Yes.
but wasn't it optional to the lady if she wanted to do it marry filing separately, just because she supported her? Based on, I didn't see any evidence that he helped her support her child, so wouldn't it be an option that she chooses to marry filing separately?
Would verifying separate be that would be an option? But you're representing both taxpayers. Which option would you tell them to put?
Yeah,
Marry
marry filing jointly.
Yeah, marry filing jointly. I was looking for marry filing jointly, and yeah, I know which one you're talking about. And then so then in that case, they had two dependents. The think about it this way: so even though they're not his kids, they can still claim credit. That's the point that I was trying to make with that one. If they do the return together, I think it was a $500 credit on that. I don't remember the fact pattern, but I think it was a $500 credit, if I'm not mistaken. But whatever credit it was, if they do a joint return, it doesn't matter if it's his. It was a 500. I think so.
They had one son. She had one son, I remember.
So yeah,
And yeah,
then in that case, it's marry filing jointly or marry filing separate. But I was asking for both of them. Not again. This couple goes to your office to get their taxes done. Are you just gonna tell? Well, I only want to take care of you because I don't like him, you know, and then he can leave. No, you're representing both taxpayers. So what is the best option for both taxpayers? And even with that, marry filing separate. Would marry filing separate work? Would that be the best filing status for her? No, it would not be the best filing status for her. But just think
it
of
would
it.
have been better if she got married next year and she did head of household, right? One day later.
No, you're adding facts to the information.
Actually, I had a question related to
Well,
marriage or one day later.
I like where you were going with that. But think about this for a second. They got married at the end of the year. Let's assume that they lived in a household before they got married. It's not always the case, but let's assume that they lived in a household before they got married. Can she still claim a head of household? Probably not. Yeah, probably not. I don't think, again, probably not. Then this is, you know, it all depends on that case. It's don't tell them she doesn't qualify for head of household on those facts given. He doesn't qualify for head of household on those facts given. I don't want you to get in the habit of making up facts. Like something like that. I don't want you to get in the habit of what just tell. I didn't hear that you got married, even though there's actual documentation that shows that they got married December 31st. I'm gonna pretend I didn't see it. I'm gonna say you got married the next year. It doesn't work that way. And this is another. You know, I got this question come up a lot, or this response. Well, I got married in my home country. That doesn't mean I'm married here. It doesn't work that way either. Some people somehow have that in their head. Well, I got married in Mexico. That doesn't mean I'm married here. No, you're married. You're married. It's, you know, it's as serious as that. You know. And the other question is, well, I got married to somebody who doesn't have a social security number. Well, then you just get an ITIN for that person. You know. Again, another situation. I just got another situation recently. People are misleading taxpayers and telling them that If the other person doesn't have a social security number, they can't do a married filing joint return. Well, what's the law? If you're married by the end of the tax year, you cannot do single anymore. But they're telling you to do single. They're misinterpreting the tax law. You got to do married filing joint and get an ITIN for the spouse. That's how that would work.
I have a
Uh,
question regarding marriage and status. Is it based upon, like, there's some conflicting information there about common marriage? Because, like, oh, I'm married in another country that wasn't filed with the United States, but would still be recognized, right?
it still be recognized if again, other countries would still be recognized here.
But I guess my question is it from the ceremony date or the court document date? Because that's a
Ah,
good question for tax status.
that's a good question for tax status. I'm gonna say that's a good question. I mean, they're usually within the days apart, but what if like yeah, that's a good question. I'm gonna just take a stab at it and probably just say when it's been officiated. That's the best that I can give you. If it's a Here, keep this in mind. If it's been officiated by the judge first, that's the date. Even though the minister, priest, or whoever officiates it afterwards, the first date counts because the judge officiated the marriage. That's the date that it would count. The second date is just more of a ceremony, like you said. I would put it on the date that when it became officiated. If the facts were reversed, if the ceremony came first, again, the pastor, priest, whoever officiated the wedding, then it's going to be that date. It's going to be the date whenever whoever was licensed to officiate the wedding, when that became final. That would be my position on it. It doesn't matter if it's a ceremony or if it's a judge or not. If the judge officiated it, then it's when the judge signs off on it. If it's a priest, pastor, minister, it's whenever they sign off on it. It's whatever comes first. That would be my interpretation. I don't see why that would be any different. Because I would guess people would try to manipulate the rules in that respect. I would just go with whatever happened first. That's going to be the starting date.
Okay. And then I have a question about medical expenses. I know for surgery there is to be a deductible, it has to be a required surgery.
Right.
But I have a question about transportation. And this is a real world one. Wait, no, it's not. So someone is transported from a hospital to a care facility, and they're transported by ambulance, but it's found by the insurance company to be a non-emergency. Is that transportation cost still deductible?
But yeah, even though their insurance doesn't mean anything.
Okay, and there isn't a requirement that it be like a required transportation, like the IRS wouldn't argue, well, you should have just taken
No,
a car there.
no. You can take the bus. You can take public transportation. Yeah, it doesn't matter.
But okay, but the ambulance ride would be a actual transportation costs.
Right. Even if your insurance doesn't cover, that's the whole point. Whatever your insurance doesn't cover, that's what's deductible.
Okay, interesting.
Yeah, that's the whole point of it. Whatever your insurance doesn't cover it. If your insurance covers it, then it doesn't even matter because you don't get a deduction for it. The
It's
insurance
true.
covered it, right? The insurance didn't cover it, well, then that makes sense. Then you'll be able to take the deduction. Yeah, and even with speaking of yeah, if you take an ambulance, sometimes they cover it, sometimes they don't. That's a good point. Even like other emergency travel, don't be surprised. They may cover even they may even reimburse you for parking, and it depends on your insurance policy. But again, that's not a deduction. Whatever is out of pocket from your end, that's your deduction. Mileage is 20 cents per mile for 2019. Any other questions?
I have one last question. For the child tax credit, is there a limit because of kids, let's say, like, does it makes a big difference? I used to work in a small CPA firm, and my boss will sometimes say, like, when people are filling the W-4 form for their tax withholding, she was saying, like, oh, more than 3 allowances doesn't really even make a difference anymore, like putting 4 or 5.
Oh no, well, you're mixing two different rules. For the allowances, that's all you're withholding. That the more you put, the less that they take in taxes. Then you're going to make it up at the end. that's a different issue altogether. But what you're asking, like, what type? I think you're asking more is what's the most amount of kids that you could claim on your taxes? There is no maximum amount. And I think here's the misconception people have. The most kids you can claim is two. There's no tax law that has that in the code. Here's another rule that people think that only claim to depend. The same thing I just said. I don't know where they come up with that. To be honest with you, actually, I think I have an idea. For earned income credit, it used to be the most amount of kids that you can claim is two. Now it's three for earned income credit. That's just for that credit alone. For whatever reason, a lot of people are just like so narrow-minded and just focus on that credit. They don't think about other credits. So they just say, well, the most kids you can claim is three because that's consistent with earned income credit. The most dependents you can claim for earned income credit is three. The most kids that you can claim for anything else, it's unlimited. So there is no number. There really is no number. Somebody is telling you the most that you can claim is three or two or whatever. That's wrong. They're misleading. The most that they can claim for that credit is two or three, depending on the year. That's it. That doesn't mean that they cannot claim more than that. Yeah, they can claim more than that. And you can claim the amount of dependents that you can claim. What a lot of people used to do, let's say under the old rules, the most I can claim is two kids for earned income credit. This is what some tax return preparers used to do. Okay, you could only claim two kids. You can only claim two kids, and what are you going to do with the other two kids? Can you have somebody else claim the other two kids? I'll say the other part again. Can't you have somebody else claim the other two kids? If I'm the preparer telling somebody else to do that, what am I committing there?
Fraud.
Fraud. I'm aiding and abetting the preparation of a fraudulent tax return. I'm not going to do that. You're never going to hear me do something like that. I'm gonna answer the taxpayer honestly according to the tax law. I'm not going to make up tax law. I'm not going to misinterpret tax law. I'm not going to mislead the taxpayers. If this person's a CPA, like you said, this person should have known better. If this person's an enrolled agent, should have known better. This person had any tax background, this person should have known better instead of making that comment. The most you can claim is three. That is not true. That is not true at all. For earned income credits, yes, but for other credits, it's unlimited.
What would be your advice? Like, let's say, like, we are all studying right now, preparing for the CPA, like to get like experience, or if we want to eventually have a CPA office or something, like what's your best advice to gain like real world experience?
Working internships. Well, first start looking at internships. Get involved with the Illinois CPA Society. There's a lot of internships. Volunteering. There's always volunteering to do tax preparation for low-income individuals, for seniors. There's always seniors, citizens, like the AARP has. Well, they don't have it anymore because of the coronavirus. A lot of these non-for-profits closed, but there's always opportunities for you to volunteer. Harold Washington College, they're associated with I don't know if it's Ladder Up or the Center for Economic Progress. It's one of those two organizations. I don't know which one Harold Washington College is associated with. I say try to get experience that way because you're also giving back to the community. You're also getting experience, at the same time. Those opportunities are always there. At the same time, they'll give you additional training. They'll give you more hands-on training, how to use the software. A lot of the stuff that we reviewed in this class, they're going to review it, but you'll still, have to do training. Start getting, again, active with the society. Become, get experience that way too. Internships would be a good way. Yeah, the thing about Harold Washington College, we don't have an externship program. We have internships, but an externship would probably work where you get experience plus a grade. Something I have discussed with the business chair in the past, and we, where give students an opportunity, because you're not the only one that has asked that question before. I'm sure there's others. And we've always talked about the possibility of doing like some kind of externship, where they get experience, and it hasn't been solidified yet. But just keep on the lookout for that at Harold Washington College. We have discussed it. I know I shouldn't be saying this, but we have discussed it. I guess I could say we have discussed it. It just hasn't been finalized. But just right now, just continue networking, continue doing what you're doing, and just see wherever you can get an internship.
Thank you.
Yeah, I can't think of anything else. Like again, volunteer would be the best way. Volunteer your time. 'Cause that also looks good on your resume. I would like personally, if I'm interviewing for somebody to help me out, and I see somebody who also has experience plus they volunteered, because I'm a big person and giving back to the community. Let's say I have two resumes. One person did not volunteer but has a degree, and then this person did volunteer and has tax experience. Who do you think I'm going to pick? Because I believe in giving back to the community, so that's an instant connection right there. And not just that, this person also has experience, plus they like to volunteer. The chances are I'm going to pick the person who volunteers and the person who didn't volunteer. Not always. Again, I'm just telling you just like what I would probably do. I would probably favor that resume, but again, it's more detailed than that. But this is just from my perspective. I would really value the volunteer aspect side of it, especially if it's doing tax preparation for low income individuals, or for military. There's always that available, or for low income individuals, retired individuals, senior citizens, or people in the military. There's always opportunities for that, and it gets you experience too. So that looks good on your resume. So look into that. Look into volunteering opportunities. That would be a good way to get experience.
Thank you.
Any other questions related to? I guess I still got some time. I don't want to leave my office yet because it's too hot, and I gotta ride my bicycle back home. So what's the weather like right now? Anybody been outside lately? Let's see. Let me see the weather real quick. AccuWeather. What's the weather like? It is. It was like 100 degrees earlier. Oh, it's not bad. It's mid 80s. It's not. It's still hot. I'll probably wait a little bit. You guys don't have any other questions? No questions?
Motion to adjourn.
Hold on. All right, wait. Let me. How do I? You're already ready to go, huh? All right, you guys better all get A's on the on the next quiz. Yeah. If everybody here does not get A's, I would be very, very disappointed. Again, you gotta practice. Make sure you practice beforehand. Hopefully, what we've done today gives you more practice, but a lot of it has to come from your end. That's all that I have for today. All right. So, motion to adjourn. Anybody? Oh, yeah, Matt, you made that motion.
Yes.
I need a second. All right, guys. I'll see you guys on Wednesday. Take care.